Audio check.
All right, good morning, everyone. Are there any preliminary
administrative matters before we begin? I think we had a read and see. I'm not sure if we've accomplished.
We are still getting some information and can report back after the break. We should be able to provide it today.
All right, thank you. Okay, so I promised last week to make an announcement this morning about additional hearing days based on the progress of the proceeding. I think at this point we are going to announce an additional hearing date, which would be Wednesday, March 8th from 11 to 5:30. We're hopeful, of course, that we do not need this time, or at least not all of that time. But I think based on our current progress, it would be prudent to hold that date. So we can revisit. We will update our external calendar and provide amended notice into the docket. But for everyone's awareness this morning, we should hold 11 to 5:30 on March 8th. Okay. Okay. Anything else before we begin? Nope. Okay, very good. Then we will resume cross. I think Mr. Capozzi has a little bit more cross.
Thank you. Yes, thank you, Chairman. Good morning. Can we please turn to RSR 68 Attachment 1? A couple more questions on storm costs.
We have that open.
Okay, thank you. So in this interrogatory, the authority asked for an identification of which storms the company incurred lien-in costs. And so that's presented in the last column. I see there's a number of storms on lines 11 through 15, I think, that there were no lien-in costs. There was no label that there were lien-in costs. So is it correct to understand that the company did not incur lien-in costs for these events?
You said 11 to 15. Are you referring to Excel rows 11 and 15?
That's right.
Numbered lines 5 to 9.
Yeah.
That's what this indicates.
Okay. What's typically included in lien-in costs?
Lien-in costs would be the pre-mobilization of resources prior to the event.
Include internal and external?
Internal resources typically would not be deployed until the event impacted us. Okay. But the mutual assistance crews or the unaffiliated contractors that we acquired in order to achieve our at onset resource levels would be.
Okay. And so internal employees wouldn't have recorded overtime or anything in advance of the storm that may have been lien-in?
There may be work occurring in advance of the storm. I wouldn't necessarily characterize it as lien-in, but flooding preparation might be one of those things. Arranging materials, lay down areas in advance of a storm.
Okay. Does the company recall that in the decision, the Tropical Storm Isaias decision in docket 200803, that the order number 8 in that decision required updates to the company's contractor timesheets?
Yes.
Okay. And does the company recall that the authority approved UI's updated contracts or contractor timesheets in October of 2021?
Yes.
Okay. Can the company provide those contractor timesheets for both storms Izzy and the blizzard. So Storm Izzy on January 17th of 2022 and the blizzard on January 29th of 2022.
Yes.
So I would request a late file, Chairman.
Very good. So that's late file exhibit 21 to provide the time sheets for all internal and external workers for January 17th and 19th, 2022.
These are for contract for vendors. Thank you. So moving on, I just have a couple questions about pole attachment make ready work. So does the company recall that in docket 190152 REO1, that the companies stated something to the effect that when performing make ready work, there is a limited supply of available line workers and equipment to draw from. And so without advance notice of attachment applications, it's difficult for the company to ensure that it can have adequate crews to deal with high volumes of make ready work, or to perform high volumes of make ready work. That's a long sentence, but I can point you to where that was outlined in our decision, if it's helpful.
Okay, I mean, I think in general that concept that quickly increasing volumes of work could create a resource challenge on the company, both for field construction resources as well as the design resources necessary to process those applications.
And is there some constraint or limitation to because of the qualifications necessary and the high skill level necessary to be a line worker and to perform that kind of make ready work? There's just sort of a general competing interests for where UI would want to apply those line workers. Is that reasonable?
We view that work as customer work, so it is high in our priority structure. But the ability to get the resources necessary, again, both in the design phase and the construction phase, can be challenging if the volumes change quickly.
Okay. In that decision, do you also recall that the authority analyzed pole replacement data for UI, pole replacement data related to pole attachment requests? And the authority found that the attachment applications, of those attachment applications UI received in the prior 3 years, it replaced poles approximately 9% of the time. That's unreasonable?
Sounds reasonable,
Okay.
yes.
Okay. Do you also recall that in the order 7 of the May 11th decision in that docket 190152, REO1, requires the EDCs to meet new make-ready timelines established, and that order number 8 requires the EDCs to report on whether the pole owners themselves and other attachers are meeting those make-ready deadlines. Do you so how many in that those do you know how many poles pole attachment requests that UI received since the date of that decision, so after May 11th, how many polls UI has done make ready on since the issuance of that decision?
Confer with my colleague for 1 second. We recently filed order 8 on February 15th. I do not have that response in front of me.
Okay. I reviewed that and it looked to me like UI had completed make ready on 50 polls over that time period. Does that sound correct?
Yes.
Okay. And I want to turn lastly I want to turn to Mr. Reeves to your testimony on page 13.
The pre-file testimony?
Pre-file testimony, that's correct.
I'm sorry, Mr. Capozzi, you said page 13?
Page 13. It should include the chart of the categories of investments.
Yes.
Okay. And here I'm focusing on the make-ready poll attachment.
Correct.
Okay. Are some or all of these costs included here? Would some of or all of those be paid for by attachers?
These would be in general, the pole replacement costs that we encounter as we go out and do our survey work, where there's a pre-existing condition that we cannot attribute to a specific attacher.
Okay, so this would qualify as so these costs would be attributed to non-billable make-ready?
Correct.
Okay. Okay. Thank you. Those are all the questions I have. Thank you very much.
Mr. Capozzi, just one clarification that you had asked me a question yesterday about the all-in SAIDI on the resiliency docket. I did a little homework overnight. Table 20 of the REO8 decision defines that all-in SAIDI as the summation of 4 years of outage duration. And then it's divided, so you have a relatively large numerator divided by the total number of customers on the system, which is how you get to the 19 minutes that you described yesterday. That didn't seem like it would be reasonable.
Okay. How do I compare that number to your normal SAIDI? What's
That summation is a variable. So by summing it, it puts it on a different basis than you would be looking at annual SAIDI, but you're comparing all the circuits with that same concept. So
right.
I think in terms of the analysis, it makes sense. You're looking at over the long term, the duration impact to customers on circuits, and because they're all on the same basis, I think you're getting a result that helps you prioritize.
Okay. Does that were there other circuits with higher all-in SAIDI calculated in that way than the 9 listed?
That analysis shows that I believe the ranking based upon all of the parameters we looked at, we could provide that SAIDI, simply looking at that one variable.
I guess I would request a late file for all circuits with that SAIDI variable.
Okay.
Thank you.
We're talking SAIDI, not SAFE, correct?
Correct. The all-in SAIDI.
It was, yeah, and it was presented in
Table 20 of the REO8 decision.
Thank you. That's late file exhibit 22.
and I think Mr. Pfaff had it.
Yes, good morning. I just have a couple of late file exhibit requests as a follow-up to our discussion from yesterday. It sounded like from the comments that Mr. Eves made that attachment 1, OCC 158, attachment 1, the supplemental response to that, which listed the plant and service amounts by FERC account, sounded like some of his corrections would impact that attachment. And so my first late filed exhibit request would just be a corrected OCC 158 attachment 1 supplemental response. Is that clear to everyone?
That should be doable.
Okay. And then my next late filed exhibit request is related to that, but I'd like a revised version of OCC 158 supplemental response attachment 1 that reflects only the plan and service that is attributable to the phase out of the corporate capital charge. Sounds like from your head nodding, that would be doable as well.
Yes, yeah,
Okay.
we just hadn't done it in the plant account basis, but we have the information to do
Okay,
that.
excellent.
So we can,
Okay, thank you.
we can maybe do that in one request to show the two different movements, if that's okay with you.
I'd like them separated, actually.
Okay.
Yeah, thanks.
Okay, so those are late file exhibit 23 and then 24. Any further requests?
All set, thank you.
Then we were going to Mr. Cadwalader.
Thank you, Chairman. Good morning, panel. Steve Cadwalader with Authority staff. If I could have you turn to Schedule B 5.1, prepaid expenses.
We're there.
What in particular drives this balance? In particular, what causes a expense to be prepaid?
Expense is prepaid when the company pays for it before it's accrued.
And I noticed there are like 5 or 6 different categories of prepaid expenses on that exhibit. I assume these categories don't change from year to year.
They could, these seem like generally they would be the categories, but maybe I would defer to someone from the company as to whether there might be variation in these. B-51.
Yeah, I think generally those would be the types of expenses that would qualify as prepaid.
In what sense is the test year typical for these balances?
Conceptually, using the example of insurance, right? We tend to have insurance policies that cover multiple periods and they're sort of cyclical when you renew your insurance. So that's a type of an example where we enter into that insurance policy, but it benefits the company and benefits customers for multiple periods of time. So we record it into the prepaid and then we amortize it through the income statement as those benefits are realized for the company. So it's a standard, typical process that we have in accounting.
Historically, how have these balances changed with the inflation rate, or do they?
I think, all external costs are subject to change based on the market and the inflation rate. I don't have specific analysis on that, but we certainly have, history in our financial records of what we would have paid, for example, for insurance costs over time.
If you could run me through, at least for insurance, say, the calculations that went into the unadjusted test year amount, I guess for the total of, I guess it's 1,969,000 to the rate year amount of 1,994,000.
Can you just confer for one moment,
Sure.
please?
I don't know if we have that at our fingertips, but we'd be happy to provide the work paper that supports this adjustment.
Okay,
That would
that'd
be
be great.
helpful. Yeah.
Thanks.
Okay, Mr. Cadwalader, that would be late file exhibit 25, and it's to provide the work paper that supports the unadjusted test year amount. From which schedule, please?
It's Schedule B, 5.1,
5.1.
5.1A in particular.
And it was, you wanted it specific for the $1.9 million amount?
So 1.969, and it takes it to 1.994 million.
Thank you.
And how do these prepaid expenses factor into the working capital allowance that the company is requesting?
So from a rate-based perspective, these prepayments are in addition to the rate-based calculation, representing the fact that the company has prepaid the amounts, and we held them flat through the rate years.
Did you pull it out of the cash working capital allowance calculation?
I would have to defer to Mr. Adams, who was the cash working capital expert.
Yeah, Mr. Adams was part of the prior panel, but we could follow up with more information on that in a late file if that would be appropriate, or we could get it on a read-in maybe.
Yeah, that would be fine.
Yeah, either way would work. Thank you.
Okay. So let's try read-in for that, which would be read-in D, please.
If I could refer you to Schedule B 8.0 reserves.
There.
Seems like the biggest part of this this balance is the storm reserves. Are these amounts that the company has already spent but has yet to recover from ratepayers? Is that the basis for the reserve?
Yes, that's a fair summary.
And have these amounts been vetted by the department or the authority?
We responded to a data request describing the information we've already provided to the authority on storms.
Justifying the balanced amount?
Yeah, I'd be happy to find that data request if that would be helpful.
I can find it, thanks. And the company is suggesting amortizing these over 5 years, is that also correct?
Correct.
What's the basis or rationale for the 5-year amortization period?
Generally, we proposed 3-year amortizations for our regulatory assets and liabilities to be aligned with the proposed 3-year term of this rate plan. But given the materiality of the storm reserve, and there was one other regulatory asset where we also proposed a 5-year life, we felt it appropriate to propose a longer life, or longer amortization period. Recognizing that there's a balancing act between minimizing rate pressure today and kicking the can down the road forever, we picked 5 years. It's our proposal.
Okay, thanks. Does the company expect these storm reserves to be added to over the period of the 5 years?
One of the company's proposals in this case is to increase the storm reserve accrual from $2 million per year to $3 million per year based on our recent storm experience.
And absent the authority granting that increase, would you expect the storm reserve to be added to over the period of time?
We haven't forecast our major storm costs, but generally we do expect storms to continue. And I imagine there are others on this panel who could add to that if needed.
The bad debt reserve, Is this amounts that customers have pre-funded for bad debts? Is that the basis for the reserve?
Just confer.
Mr. Cadwalder, I'm not sure these are pre-funded as your question asked. This is a proposed reduction to rate base that the company had had in its rate base in the last case. And so we carried it forward for that purpose. We didn't have a reason to not include it here. And for consistency, again, it's a reduction to rate base that we included here as well.
Okay, and you don't expect that reserve to change over time? It's just a fixed amount?
For revenue requirements purposes, it's a fixed amount.
Also, with regard to the calculations that go from the unadjusted test year amount to the rate year one amount, are there work papers that are filed in the case now that make those calculations, or would this have to be a late file as well?
And I'm sorry, is there a specific line item? Are you speaking about the allowance for bad debts?
I'm thinking, going back to the total reserve account, the unadjusted test year amount is $7,508,000. And just bringing that to the rate year one amount of $4,400,000. Are there calculations that show how that's done, or would we need another late file exhibit?
Maybe I could start by describing it and then see if that answers your question.
Okay.
So if we take the storm reserve, for instance, going from the historical test year to the rate year, it includes additions of storm reserve accruals between the historical period, and it also includes a pro forma adjustment that reflects the amortization of that asset over the first rate year.
Yep. That's for the storms?
That's for the storms.
And the others seem to be pretty much fixed amounts except for the interim period adjustments for injuries and damages.
Right, and I'm just reviewing the schedule quickly. I'm just going to confer with my colleague quickly.
For injuries and damages, there is a FERC rulemaking in docket ER 20-2054 that now requires a portion of this balance to be reflected in our transmission rates. So we've made a pro forma adjustment to be consistent with that change.
And with regard to the injuries and damages, in what sense is the test year a typical year for that balance or reserve?
Like allowance for bad debt, this is something that was included in the previous case that we've had no reason to change.
Okay. If I could refer you to Schedule B 9.1, customer advances.
We're there.
What in particular drives this balance?
So my understanding, so customer advances for construction would be when a customer pre-funds construction work that they're liable for, right? So if it's a big construction project and they pay a certain amount upfront, we maintain that on the balance sheet until we actually do the construction work, and then we move that balance into plant consistent with the additions, so that we have the right timing of those, payments with our actual construction expenses that we've incurred.
Does that, does that balance change with inflation or with economy or anything like that?
Yes, and also which projects customers are seeking, right? So it all depends on the scope of work in any period of time. So
Any reason to believe that the test year is typical for this particular balance amount?
I think it's fair to say that it's typical. It reflects, current costs and current construction standards and current demand for this type of work from customers. Yes.
Okay, if I could refer you to Schedule B, 9.3, accrued vacation.
We're there.
Do you know if this balance varies by full-time employees?
I'm not sure I understand your question.
Does the accrual amount, the accrued vacation amount balance, does that change if you have more employees, less employees?
This balance reflects vacation time that has been earned but not yet taken by the company's employees. I don't know that we've specifically considered whether it would vary based on the number of employees the company has.
Seems like if you'd have more employees, you'd have more accrued vacation balance, all things being equal.
I think the other piece there is as Mr. Hurwitz said, the amount of vacation that's taken, and that's the other component that could offset or vary independently.
Do you know if things like wage increases would change the balance as well?
So I can add to, because it's an accounting accrual that we calculate. So the first point I would make is that it's capped. So employees can only carry over a certain amount of vacation time. It can vary depending on if there's a specific union contract, but generally the non-union employees can only carry over 40 hours of time. And we calculate and true up that accrual at the end of every year based on, to your point, what are current salaries, and then how much time does any employee have in the bank, per se, at the end of the year. And the reason why we do that is because if an employee were to depart the organization in the following year, the company would be liable to make payment to that employee for those hours that they had accrued but not used in the previous year. If employees don't depart the company, it's sort of a rolling accrual that we look at the end of the following year, depending on if they have used all of their vacation time in that year. If that helps.
Could you go through the interim period adjustments that are shown on that exhibit and kind of detail what is happening there?
I would defer that.
It's similar to the injuries and damages adjustment we just discussed. It's covered by that same FERC rulemaking.
Okay. And the company is increasing full-time employees over the 3-year period. Is that also correct?
One of the adjustments we've made in the revenue requirement is to reflect the company's proposal to increase the number of FTEs.
And you don't think that would drive the accrued vacation balance?
It's not something that we've specifically studied. As we've discussed, there are a number of factors that may cause this balance to fluctuate.
Okay, thank you. If I could refer you to Schedule B 9.5, customer security deposits.
We're there.
Is there anything in particular that drives this balance?
This reflects the customer security deposits on the company's books.
And you have a pro forma adjustment of $1.4 million roughly. What's the basis for that adjustment?
As reflected on Schedule B 9.5, our unadjusted test year balance was 0 because this was not in previous UI rate cases included as a reduction of rate base. However, in reviewing other Connecticut rate proceedings, we found that other Connecticut companies were including this as a reduction of rate base, and we chose to follow suit.
And where was this before, when it wasn't a reduction to rate base?
I'm not sure how it's accounted for historically. I imagine this was a component of our balance sheet that was not picked up for rate base in the previous rate proceeding.
In what sense is this $1.4 million balance considered typical or normal?
One moment. We provided information about historical security deposit balances in a data request response, and we're just searching for that response.
Great.
It's OCC 18.
Thank you. And has the company noticed various factors that change this balance, such as the unemployment rate or inflation rate or anything like that?
We haven't specifically studied that. In reviewing the historical security deposit balances, it appears to be declining. So we felt holding it constant at the test year level was reasonable, if not conservative, for revenue requirement purposes.
So the trend was downward?
Yeah. It was OCC 18, attachment 1, that provides that balance by month from January 2017 through September 2022.
Okay, thanks. Chairman, that's all the questions I have.
Thank you. Mr. Bakari?
Good morning, Commissioners. Good morning, panel. Sulaiman Bakir for Bora staff. Please turn to your SFR Schedule H 1.01. Let me know if you're there.
One moment. We're there.
Okay, if you go to page 51 or 52, how much of the unallocated intangible plant? I believe the figure is 132, 243, 608. How much of that was indirectly allocated to transmission?
Excuse me, the version of this document that we have is the one with print error, and I think we refiled this to be more legible. I'm hoping that council can help us with
I'm referencing the most recent filing, the legible one from October 4, 2022.
One moment.
Okay.
Please repeat your question.
The unallocated intangible plants of 132,243,608. How much of that amount was indirectly allocated to transmission?
Mr. Picard, could you provide a line item for that?
It's the footnotes for the intangible plant on page 51 of 52 at the bottom of the page. There's a note reference for both intangible plant and general plant.
Oh, you're looking towards the bottom of the page.
Yes.
With the directly allocated to transmission amount of $50,362,184. That
That's
section.
correct. My reference is to the unallocated amount, the 132,243,608.
Thank you. Now we see that.
Okay.
Apologies.
Okay.
Your question was how much of
that was ascribed to transmission?
One moment.
Okay.
In our supplemental response to OCC 158, we provided the total amount of intangible plant that was allocated to transmission. So the portion of unallocated general intangible plant that was allocated to transmission would be equal to the amount we provided in response to OCC 158, less the directly allocated amount indicated on the page you pointed us to.
And what's the figure that was referenced in that OCC response?
The OCC response indicates that the miscellaneous intangible plant allocated to transmission was $75,050,861.
And that's the aggregate amount, not that included the both direct and indirect allocation. Is that correct?
Correct. That includes both direct and indirect allocations.
Okay. Similarly, if you remain on that same page 51 of 152, how much of the unallocated general plant, I believe the figure is 259,170. 555 was indirectly allocated to transmission?
It would be a similar answer. Our response to OCC 158 on Excel row 55 indicates that in 2021, $67,629,276 was allocated to transmission in total. That includes both direct and indirect allocations.
And what methodology do you use to allocate the unallocated intangible plant and general plant to transmission?
We use the company's wage allocator.
The wage allocator from 2021 or 2020?
It will vary by year, and we use the most recent information available at the time.
Okay, that's fine. Turn to your response to RIU 3487, attachment 1, please.
RRU 347 attachment 1.
347, attachment 1, please.
We're there.
Okay. If you look at the 2018 transfer / adjustment, could you explain why all the general plans of 16.99 million was allocated to this distribution?
This will be similar to the discussion yesterday regarding the elimination of the corporate capital charge. I believe this is that same concept.
The entire transfer was added to distribution. Are you saying none of that, approximately 70 million, is allocated to transmission?
I'm sorry, I didn't understand your question.
The general plan that was transferred to distribution, are you saying the entire transfer was to distribution and none was transferred to transmission?
No, that's not what we're saying. The first several lines of RRU 347 UI attachment 1 represent the amounts for UI as a whole.
Okay.
And then there are separate lines down below on Excel rows 53 to 59 that provide the amount of those above lines that relate to non-distribution items.
Okay. The road that you just referenced, I believe, row 49 and 47. Could you explain why only $31.142 million of the total general plant was allocated to transmission?
You're asking if I can explain why only 31 million of the general plant balance reflected on Excel row 49 was allocated to transmission?
Which is 241,797,000. Out of the 241, only approximately 31 million is ascribed to transmission.
Yeah, again, our allocation approach is to take that general and intangible plant that's directly assignable to transmission to do so, and then to allocate the remainder with the wage allocator.
Okay. Similarly, if you look on row 50 and 58, for the intangible plant, the total intangible plant is 225,551,000. Subject to check, only about $15 million is allocated to transmission. Is that correct?
That is the number shown here.
Okay.
And if I could just expand on that, there may be some timing considerations in 2018 with the timing of exactly when in the year the corporate capital charge began to be phased out. You can see in the following year, Excel column H or calendar year 2019, the amount of intangible plant removed as non-distribution goes up significantly. And I think that's because the phase out of the corporate capital charge was present for more of the year.
All right, thank you. Regarding the transfer to distribution, I guess your answer would be the same for the 2021 transfer, the 44,715,000.
Yeah, again, our approach is to take that general and intangible plant that's directly assignable to transmission, remove that, and allocate the remainder with the wage allocator.
So essentially, you transfer the entire 44,715,000 to distribution and then reallocate the amount for transmission. Is that correct?
I think I nitpicked your question because you used the word transfer. So we're not transferring it, but for rate making purposes, we're not including it in distribution.
As the company provided the FERC Form 1 for 2018 in this proceeding?
From 2018?
Yeah.
I'm not sure. We've provided excerpts of it, certainly. I don't know if I don't recall if we provided the whole thing.
Can we have the entire 2018 FERC Form 1 report filed in this proceeding? If it's not already in the,
of course,
in the dockets. Okay.
You're just seeking a copy of the entire 2018 for Form 1?
Yes, please.
Of course.
Chairman, that's late fire. The request is for the company to provide the 2018 FERC Form 1.
Do you mind if we confer for one moment just to check if we've provided it already?
Okay.
That's fine. If we don't recall providing it, but if we have, we'll point to where it was provided.
Okay, so that would be late file exhibit 26, and it's to provide the 2018 pro forma for which item, Mr. Bakari?
That's the FERC for Form 1 for 2018. When will the company file the FERC Form 1 for 2022?
Actually, I believe I just found the FERC Form 1 filed. It looks like we filed 2013 through 2021 in OCC 95. So, yeah, we thought we had.
So OCC 95?
Yes.
Okay, thank you. So we'll strike late file exhibit 26.
So, subject to check, I believe, we generally file the FERC Form 1s on, I think, beginning of May. But I have some colleagues here, we could confirm that if we could do a read-in with that. We have a date that we're bound to for filing, so.
Would that be filing this proceeding prior to the close of this proceeding?
I believe it's in May that we file that, so.
My question is, would the company be able to file that same 2022 Form 1 in this proceeding?
I think the evidentiary record, I think is scheduled to close sometime right around the end of the late filed hearing, which I believe is in late March. So I think I'm hearing the witness say that the FERC Form 1 would not be completed and filed by then for 2022. Is that right?
Yes, that subject to check. I'm quite positive it's not March, but it may be late April or sometime in May, but I can confirm that with my colleagues.
Okay. And does the company know when Avangrid will file its 2022 Form 10K?
That was yesterday, I do believe.
Can we have a copy of that filing this proceeding?
Yes.
Okay, so late file exhibit 26 will be to provide a copy of the 2022 Avangrid Form 10K.
Turn to SFR Schedule B 1.0.
We're there.
Could you explain what the company meant by obligation under capital lease non-current?
I'm sorry, could you ask that again?
Could you explain what the company meant by obligation under capital lease?
You're asking me
non-current.
to explain the obligation under capital lease non-current line. The company has certain capitalized leases, and there are two lines related to this. The first is Excel line 27, which is numbered line 17. The second is the line you pointed us to, Excel row 48, or numbered line 38. And we removed both from the rate years. They're a net reduction of rate base.
Okay.
And we removed that reduction, or excuse me, we removed both lines.
Okay. That was offset to rate base in the test year, but the company did not report any such obligation removed as an offset for the rate year. Is that correct?
Company did not report that as what? Excuse me, I'm sorry.
You remove it from the test year. Is that what you're telling me?
Yes, it was in the test year columns, and we removed it in the rate years.
So it has no impact on rate base for the rate year?
In the rate years, it does not.
Turn to OCC 79, attachment 5. If you look at the Excel row 425, the company reported accumulated deferred investment tax credits of 10,628,384. Could you explain if this amount was used to offset the rate base in this proceeding?
I don't recall. Our approach to calculating accumulated deferred income taxes was described in response to RRU 421, and that detailed those line items of the FERC Form 1 that we used. I don't recall how this fits into those.
Would the company be able to find out whether these amounts of accumulated deferred income tax credit, investment tax credit rather, was used to offset rate base for this proceeding?
Sure, we can find that.
Okay, is that a read-in or a late file?
We could try to find that at the break, and if not, take it as a late file.
Okay. Let's mark that as a read-in for now, which would be read-in E, and it's about investment tax credit offset.
As an offset to rate base, yes.
Thank you.
If you remain on the same exhibits and you look at Excel row 398, 420 and 421, could you explain why the company was referencing on those row New York State DIT?
I'm not sure why that account label is here. We could also look into that if that would be helpful.
Okay. Subject to check, if you look at 398 row again, the excess deferred income tax on that row, that's an unprotected deferred income tax, is that correct?
It is labeled excess DIT, which I presume stands for excess deferred income taxes. I'm not sure whether this line is protected or unprotected.
Could you find out whether that amount is protected or unprotected?
Sure.
Okay, can we make that part of reading E?
Yeah, let me just take note.
Okay. If you look at Excel row 422, subject to check, the total amount to 225, 742, 169. Discuss if that amount represents the total 83 fundable to rate base.
One moment. OCC 79 UI attachment 5 reflects the company's trial balance for calendar year 2021. We itemized the components of accumulated deferred income tax that we've included for revenue requirement purposes in response to RRU 421. The balance presented in that attachment for accumulated deferred or excess accumulated deferred income taxes is $252,015,805, which is the sum of Excel rows 398 and 422 in OCC 79 UI attachment 5.
Okay. Chairman Gillette, that's all my question for this panel.
Very good. Thank you. Mr. Vacalina. Mr. Vacalina, just step out. Okay. Okay, let's take a 10-minute break and see if we can address some of these. Are you back? Just in time. Okay, very good. Strike that. We'll try to keep going here. Mr. Vacolina will resume cross.
Your name tag. Define time to- Good morning. Jim Vacolino with Pura staff. My questions center on the Bridgeport Avenue property, and I believe this is the correct panel. I see a number of witnesses here that sponsored interrogatories. Is that a fair assumption? Yeah, yes, it is. Okay. We have, well, yeah. All right. Just a few preliminary questions. The Bridgeport Avenue property was 100% distribution related. Is that correct? Were there any transmission activities that took place there, storage, operations, or other?
Having worked there, there were our ECC was in that building, so the ECC did control transmission. So it was generally a distribution work center, but there were some transmission functions within that facility.
As a result of the accounting that we've seen here, has the company applied any transmission allocation factor to any of the results here up to and including the $15 million regulatory asset?
No, the $15 million regulatory asset does not reflect any transmission allocation calculation.
Okay. Yeah, sort of, I request a late file exhibit about which would capture what any transmission related allocation would be for that property and calculation of what that is related to what you're asking for in this rate case. I'm sorry, is it?
We're at late file exhibit 27, and Mr. Buckley, can you state the property name one more time for me?
Bridgeport Avenue transmission allocation. OCC 139. Questions about timing here. OCC 139, it states Bridgeport Avenue was removed from rate base on January 1st, 2015. If I take a look at EOE 165, I see that the Bridgeport Avenue property was removed from utility property to non-utility property in June 2016. Can you differentiate between those two dates and what the treatment was in June 2015 compared to being in utility property and not being in utility property as of June 2016?
Sure. In one of these responses, and please forgive me for forgetting which, we provided the work papers and citations to the 2013 rate case, demonstrating when the Bridgeport Avenue property was removed from rate base for rate making purposes. And then partway through 2016, the company recorded a journal entry on its books to reclassify the property associated with Bridgeport Avenue to non-utility property.
Okay. Would you have had in 2015 you would have removed it from rate base as a result of the rate case at that time? Is that?
Yeah, we removed it from the revenue requirement as part of the ongoing rate proceeding.
That would have been year 3 of a 3-year rate plan?
My recollection is it was only a 2-year rate plan,
2-year rate plan, okay.
but
You made a specific adjustment in that rate case to remove it in the 2nd year of the rate plan?
we did, and I believe in that proceeding, there was a late file exhibit demonstrating that removal.
And that essentially offset the fact that it was in utility plant and didn't get transferred over to non-utility plant until June of 2016.
I think the answer is yes. The way you used the word offset was confusing a little bit to me, but I think the answer is yes.
Okay. Yeah, I can rephrase. So if it was in utility plant or utility property up to June 2016, I assume it would have flowed through similar to other rate-based items. If it didn't get reclassified to a non-utility plant until June of 2016, the offset would have been the adjustment that you made in the 2015.
Yeah, it would have flowed through rates if we had not made the adjustment described.
Thank you. Now, the removal of that property from rate base in January 1st, 2015, that actually coincides with the when the Bridgeport Avenue lease would have expired. Is that correct?
No, I don't think that's correct.
Okay. So I believe you had a 20-year lease that started in 1994. Okay, and getting a little further out of myself here, but then I think you purchased it at year 10, which was 2004.
That I agree with.
Okay.
I admittedly do not recall the exact date, but 2004 sounds correct.
Okay. So if I had another 10 years to the 2004, I come up with 2014. It's my simple math there.
Oh, I see what you're saying now. Yeah, I was confused because we owned the property at that time. And so at the time we removed it from rate base in the 2013 rate case. And at the time we sold it, it was UI's owned property. But had the lease signed.
Was there any connection between, I guess, the expiration of the lease and the removal of the property from rate base on January 1st, 2015?
I was not part of that proceeding. In my review of the transcript and the late files, I don't recall that being the reason.
EOE 165, back to that. It shows the beginning and accumulation of carrying charges on 616. What is the significance of the carrying charges to that date?
Could you please repeat the reference?
EOE 165.
Were you referencing an attachment?
Yeah, so that would be, yes, attachment 1, page 1 of 3.
Okay, I'm there.
Okay, yeah, and the question was the significance of accumulation of carrying charges on 616, June of 2016, when the property was removed from rate base in the previous year.
We provided a couple of data request responses describing why we think the recording of carrying charges is consistent with foundational rate-making principles. And as shown here, we've calculated carrying charges historically consistent with the activity.
Sure, and I understand the arguments that the company's made regarding the carrying charge being applied. I guess my question more gets to the timing of 616, June of 616 versus some other period. Why why did you start accumulating carrying charges at that point?
We'll confer for one moment. Mr. Vocalina, on that same schedule that you were pointing to, EOE 165 attachment 1, there's some details in Excel column L regarding the various, or certain of the various entries made in that schedule. And the coincidence of recording carrying charges was with when the company recorded its impairment on that property.
Okay. Thank you. And I'm sorry, can you schedule EOE 165, which attachment was that?
That was attachment 1.
That's not attachment 1. Okay, 2 up. Okay, recording. Okay. Thank you. Okay, OCC 139, please. I figured it's faster me manually or you the computer.
We're there.
I think you're maybe beating me. Okay. So the property was acquired in 2004. I think we've established that. Purchased for $16 million. And essentially the justification was to avoid a significant rate increase. I have the numbers, I believe at $1.7 million at the first 10 years would have increased to $3 million per year.
I don't recall the exact amounts, but I do agree that that was the consideration at the time. It was to avoid a significant lease increase.
Okay. What was the, so purchase for $16 million, what was the appraised value of the property at the time of purchase?
I'm sorry. You're asking for the appraised value at the time we purchased the property in 2004. We don't have that at our fingertips. We provided, we had 2 appraisals for when we sold the property in 2017. We're searching for whether we have access to the appraisal from 2004, but we don't have it at our fingertips.
Okay, if I prefer to do a read-in or a late file exhibit on that number.
Is read-in possible, or would you like to take a late file?
Could we try a read-in first?
Sure. So read-in F is the 2004 appraisal amount.
I'm sorry, I was conferring with my counsel.
Read-in F, the 2004 appraisal amount. I have that right.
Okay. Okay. OCC 171.
So the question was explain in detail the company's decision to buy 801 Bridgeport Avenue, given that the building would not be needed after the central facility project was complete. And the response was the commencement of the lease and the decision to purchase predates decisions associated with the property as part of the central facility. So at that time, 2004, the company had no intention of utilizing Bridgeport Avenue in this central facility plan. When you purchased it, am I characterizing that correctly?
2004 significantly predates my time at the company.
Yes.
Just one moment.
Okay.
Where is it?
Oh. Chair Gillette, thank you for the moment. This is a question that is more outside of the witnesses that we have at the table. It was sponsored by a different witness that we do not have here. If we could have until after the lunch break, potentially, we're going to try to either produce him or somebody who can speak to Mr. Vocalina's questions.
Okay. Okay, Mr. Vacalino, please proceed.
Thank you.
I'm sorry, one second, Attorney Venora. Mr. Vacalino, what was the underlying interrogatory, please?
OCC 171.
And the responding witness was whom, Attorney Venora?
It was a Mr. Thomas Hulk, who we did not expect to need for purposes of hearing, but.
And who adopted OCC 171, please?
I'm sorry, I'm getting some information in real time. He had a family emergency yesterday, so he was actually on our list of support personnel to be here today, and that's why he's not here.
Okay, but somebody adopted his interrogatory at the start of this panel, correct?
Correct, for purposes of admission to the record, to make sure it was in the record. That's right. So we're just scrambling to try to get somebody who can speak to his issues.
I appreciate that, but when we adopt the materials into the record, it's on the basis that the witness who's adopting it can speak to the veracity of the matters in that interrogatory. So who adopted it, please?
Well, we had Mr. Hurwitz adopt it.
He cannot speak.
I'm sorry, Mr. Eves did. But it's a level of detail, I think, on the questioning. It's sort of a question of the level of detail. So as I take it, Mr. Vocalina is asking some follow-ups. Excuse me. Chair Gillette, could we take a 5-minute break, and we may be able to have somebody in the room that can speak to these to try to keep this moving.
Mr. Eves adopted the interrogatories?
He did.
I mean, I'm inclined to proceed if the witness adopted the interrogatories and which to me signals that you're able to speak to the interrogatory, and the company cannot respond to the questions based on that interrogatory. And I think that the answer is the company cannot meet their burden on that matter. So, I mean, I'm willing to hear you out in response, but I think that my expectation as we're moving through this and the company was adopting interrogatories but not producing those witnesses was that the folks who are adopting those interrogatory responses could then speak to them.
Right, and that is our plan, but it gets to a certain level of detail on the response. We had about 1,800 or so interrogatories in the case, so we were trying to produce the panel that's most responsive to what we believe are, the most likely issues. And there are some issues here that are going to come up at a level of detail. So our plan for all of these hearing days is to have those additional folks here and available to the extent we do need to bring somebody up to the table, like on those issues, just trying to keep the panels at a manageable size. We're caught short today because of Mr. Hulk's family situation. But I think if we can take a couple of minutes, we may be able to come up with a workaround here to enable Mr. Vocalina to continue with his questioning.
I appreciate that. I'm not inclined to take a break at this moment, so I'll have Mr. Vocalina continue. And if the company's witnesses that are here cannot respond to it, then we will move past those questions, please.
Okay. Mr. Donnelly, if we could identify and swear him in, he can assist Mr. Eves in responding to these questions.
Okay, Mr. Donnelly, if you can, Attorney Venora, can you identify
Yes.
Mr. Donnelly?
Yes, we have Kevin Donnelly. Mr. Donnelly, would you just please state your full name and position for the record, please?
Sure. Kevin Donnelly, Senior Vice President of Planning and Regulatory, here
Okay.
on behalf of United Illuminating.
Thank you, Mr. Donnelly. If you could raise your right hand, please. I swear to tell the truth, the whole truth, and nothing but the truth under pains and penalties of perjury.
I do.
Thank you. Okay, Mr. Vocalina, if you can proceed with your questions.
Yeah, okay, going back to OCC 171, you need me to repeat the question, but the crux of it was that the company states that the commencement of the lease and the decision of purchase predates the decisions associated with the property as part of the central facility. When was the central facility first considered internally?
So from memory, and I think we had a lot of discussions here, if I recall, the central facility was first presented in the company's 2005 rate case as a consideration for being able to move forward and have a more sustainable and viable option for centralizing the company's particular operations center and putting it on the I-95 corridor.
Okay.
We proceeded with that to 2008 in that rate case, and then ultimately had the approval in the 2013 rate case as well.
Okay. If I take a look at,
Svacalina, you cannot hear you.
oh, sorry, if I take a look at decision 110808, I'm on page 2. It talks about UI's real estate strategy review that was initiated in 2002. Can you talk to what that real estate strategy review consisted of?
And from memory and generally speaking, the company had been looking at its future needs, what would be the best way to address those, understanding that there would be a period of time where we had the 801 Bridgeport Ave Shelton facility, that a decision would need to be taken in order to continue to maintain and operate that building. There were considerations for looking at an overall centralized location. It was at one point perhaps building out at 801 Bridgeport Ave from what I recall. It was looking at different locations and locales that would be more centrally located to our overall territory. Opportunities to be on a major highway if possible for our line trucks and being able to access all points of the system in a more timely and readily available manner. So I don't know that docket, or I don't have that document in front of me, the 2002 strategy document, but that's what I would generally understand.
Be one of my next questions. What was this real estate strategy review consist of? Was it some sort of internal UI committee that had a real estate strategy investment that evolved over time from this 2002 period to when the decision was made, I guess, in 2005?
Sure. So our former president of United Illuminating, Tony Valillo, was in charge and overall executive sponsor of that process. And we had various executives who were part of a larger steering committee and had responsibility for that specific evaluation. One was Ed Drew, a vice president, who had the overall responsibility within his team of coordinating and putting this strategy together. Ultimately, that was up to the highest level of Tony Valillo. We had others, you may recall, or Vice Chair and Commissioner Karen may recall some names like Joe Thomas and Rich Reed, again, executive levels within the company. That assessment was put together with a vision towards the future. I believe we had an external consultant also help. I know there was at times various conversations around what would be the best utilization of the assets that we had. 801 Bridgeport Ave, the decision was taken, as you noted earlier, to purchase it. It was at the time I thought to be a cheaper alternative than continuing with the lease arrangement, to then take ownership of that building, to have an opportunity to make improvements as necessary, and for also future consideration if that were to become the operation center in a modified or retrofitted way, that we would continue to operate well into the future.
So linking the real estate strategy review started in 2002, and this 170 OCC 171, where it says that 801 Bridgeport Avenue was never a consideration. It wasn't a consideration up to this point. Is there anything that the company can provide? Were there interim steps, decisions made, status reports of this real estate strategy review group? I know this started in 2002, and we're talking
so reaching back into the memory breaks here, I can recall the individual, Phil Turner, who was our internal point on that particular project and effort. Reaching back 21 years on what we might have available for documents, for data, anything that could be electronic documents, we can do a search, right? We can go back and see if there's something that we could produce from 2002. Don't have it top of mind at the moment.
Yeah, if could do that.
We're at 28.
28, okay.
Okay, Mr. Vacalina, so we're asking for the company to provide work papers or other internal documents indicating
really the timing of when 801 Bridgeport Avenue was considered to be part of the central facility plan.
And if I could clarify, Mr. Vacalina, for a moment, just on what you just said a moment ago. So the various aspects of the central facility plan and producing ultimately a strategy around a central campus always considered what would come of 801 Bridgeport Ave, whether it would be potentially a site. It wasn't ideal with its location. Mr. Eves, who worked in there, would tell you just by its physical location, the ability to get to all points of our territory in a timely manner, especially for storm response, was not ultimately ideal. We found that there could be better locations. With the fundamental understanding, first and foremost, and I recall, Mr. Marone testifying explicitly on this in our 2008 rate case, the plan had always and would always need to consider a net present value benefit to customers, whatever were to come of 801 Bridgeport Ave. If it were to be sold at a loss, because you have to recognize that that facility in the 801 Bridgeport Avenue in Shelton, if others here may be familiar with that area, is a very commercially developed area, and it's probably, that site was not the highest and best use to be an operation center of utility, that there would be a lot of environmental cleanup that would need to happen at that site to bring it up to a standard where it could be used for the highest and best use at a commercial standard. That would need to be offset by more than enough benefits to prove valuable to move forward. And ultimately, that was the final analysis we took, all of the documentation provided, and still the decision taken to proceed.
Okay. Specifically going back to this, though, I guess 171 in the statement was that when you decided to purchase this property, I guess for $16 million, that I believe had much less of an appraised value. We'll find out with Reed and F, I believe, but that the company maybe in the background considered 801 being part of the plan, but according to OCC 1, the decision to buy the property predates any consideration. So that's why I'm having a little conflict here of trying to figure out when the company, how they evaluated the purchase in the whole central facility plan, if it was always in there. But I'm looking at a response that says, no, when we made that decision, that was not part of the plan.
Yeah, sure. I
see the disconnect.
I do. Thank you. I appreciate that. And if I could clarify, perhaps my characterization or my statements around it. So you were, from what I recall, you were correct on 1994 with the lease, and then it comes due, and you have a decision to take, and that decision was either to purchase at that point or to continue and go enter into another lease to carry it forward, and that had certain escalating costs associated with it. Analysis was done around that. I presume I didn't personally do that analysis. That would say the best option at that point was to make the purchase. The concept of a central facility was first developed as part of that 2002 real estate strategy. I don't remember exactly when. I have a memory of 2003 timeframe when we were getting some of that output. It was been part of what we presented as a concept in that 2005 rate case. We knew that would be a difficult burden and question to put in front of the commission to be able to move forward with an overhaul. I mean, at that time, again, United Illuminating, the size of the company that was a significant investment that would need to be undertaken. We needed to continue to make progress on how we were going to maintain our current state of operations.
Okay.
We may or may not be able to go forward with a central facility. That was the position in 2005. We brought it forth. The commission was supportive enough to say continue to explore. We brought it back in 2008 and then again in 2013.
Okay. So this particular property was marketed, and I'm going to decision 110808. This is page 4 of that. You take this subject to check if you like, but the property was marketed in April of 2009, so it'd be 5 years after the purchase, at an asking price of $12.9 million. Doing the math here, I'm trying to, if an immediate sale had taken place then, at that point, what was the company's plan with respect to Bridgeport Avenue employees, since the central facility wasn't completed and 3 years later?
I think a few things at the time would have been considered. one, if a sale was consummated or we're able to at least enter into a purchase and sale agreement, we would have looked for opportunities to stay on that site for a period of time. And maybe it would be a period that would bridge us to the final completion. That would most likely be our first strategy, given that we ultimately were in construction after 2008 and we ended up completing construction and ultimately occupying in 2011, 2012 timeframe. If that were not to be successful, I'm not sure we would have consummated the deal. And the reason I say that is our operations center, particularly, and Mr. Eves can talk more specifically, yes, particularly our field workers, our garage, our line trucks, our ECC, you just don't pick that up and put it into like a general office building. We had a lease that was basically across the street for some additional office space that we had started to use as we were also running out of room at 801 Bridgeport Ave prior to that time frame, and had started to locate some of our support personnel for the electric system there. I'll pause, Mr. Ejit. Anything further to add?
No, that's accurate, Mr. Donnelly. Armstrong Park was a facility we used for project management engineering resources in that time.
So at that time, in April 2009, how many employees would have been housed at 801 Bridgeport Avenue?
I have a broad range recollection. It could have been 300-400. Again, most of those also were, perhaps half of them maybe were field workers that they would use that as their home base, but not physically occupy the building all day.
Okay. I guess just to summarize, there was a marketing of the property in 2009, and the company would have had to come up with some contingency if, for those 300 or 400 workers, if the deal, if everything went as planned and you were able to sell immediately. Is that a fair?
Yeah, fair assessment. Again, a sale process takes 18 plus months, particularly with environmental evaluation, site remediation, and so on. It would have been very unlikely that if we marketed in April of 2009, we would have had an ability to sell and complete that deal, perhaps before 2011 timeframe. And then we were very close at that point. Would have probably negotiated just a small extension.
And at this point, the plant, I'm looking at 2009, the plant balance would have been approximately, I'm not taking into consideration depreciation, but $20 million, and that would have been $16 million of the purchase and $4 million for improvements. Does that sound?
Subject to check. Okay. I don't have those numbers readily available.
Okay.
Understood.
And OCC 566 states that UI stopped using the ESWC, which is Bridgeport Avenue, one and the same, for utility service in May of 2012. Now, if I look at the rebuttal testimony of the revenue requirements panel, it states on page 34 that some operations remained in Bridgeport Avenue until March of 2013. What's the difference between those two dates? Or what accounts for that?
Mr. Broccolini, just to clarify, I thought I heard you say OCC 566, but we're trying to find the right reference.
Mr. Vocalino, my recollection there is it took us some time to move the ECC from the Bridgeport facility building into the central facility to ensure we had all the backup sites and that transition ready to go.
Okay. Yeah, so I'm looking at 566, which refers back to 170, OCC 173. States the company stopped using the facility for utility services in May of 2012. That is OCC 566.
So appreciate the time just to get an opportunity to look at the various responses in our rebuttal. I think as Mr. Eves just stated, and what's in our rebuttal is really clarifying that while we had received that certificate of occupancy, which allowed full move in and operations to start and commence at 100 Marsh Hill Road, we did have some of our utility workers and service still in 801 Bridgeport Ave and also available if needed to utilize 801 Bridgeport Ave until the March of 2013 timeframe, particularly the dispatch center.
So it was not an issue of the central facility not being able to house these employees
No,
at that time, in the 2012 time period,
no, correct. The 2012, we got the certificate of occupancy and it was.
which would have
fully-
accommodated everyone, including those
Correct,
workers that remained at Bridgeport Avenue.
correct.
All right. Okay, just to go through a little history here. Sorry to walk you through this, but the sale by UI was approved by Pura in a docket 110808, and that was November 16th, 2011 decision. That would have been 7 years after the purchase by UI. And you can stop me if I'm mischaracterizing anything. So, I mean, subsequently, that deal, as it's characterized in the pre-file testimony, fell through in December of 2012. And the property was remarketed by the company, but the company did not find a buyer until 2017. And it was sold on December of 2018, which would have been 9.5 years after it was first marketed. Is that correct? Correct. So in docket 050604, net present value analysis was performed. If you recall that or not, I have could cite you to the reference in that docket, EL 36-1. It was an interrogatory. At that time, it showed a positive through 2026 net present value of $8.2 million. What loss was estimated in the 20-year net present value in that analysis? Would you know what that would be? there an assumption of a loss in there?
Yes, it would have included an assumed loss on the building because Bridgeport Ave, as I had mentioned, 801 Bridgeport Ave, had always been analyzed and looked at as if we were not going to recoup the full net book value.
Okay.
The amount of the loss escapes my mind. I don't want to give you a number that I'm thinking on in a range, but we can easily look back into, I'm sure it's in the record in docket 050604.
Yeah, I reference page 33 of the rebuttal testimony of this panel, other revenue requirements panel, which talks about a loss was estimated in that. So if I could actually get a look at what the assumptions were. Right now, what I have is really a net present value, which just gives me raw numbers with no assumptions behind that. We could take a refiling of what the company filed in 050604 with those assumptions. That would be helpful.
Sure, I can envision and remember a late file that I think laid out perhaps everything. So
Okay.
I know there's information in the record. We will find what's most helpful.
Okay, so it'd be late file exhibit 29, correct?
29.
29, okay. That's 050604 net present value analysis and assumptions. Okay. So I guess I'll take a look at that, but if there are any assumptions, I will take a look at it. If when the central facility approach, when it was estimated that the Bridgeport Avenue property would be sold and out of rate base, if there was an ability to do that back in 05. So going to OCC 565, and I'm referring to the, I guess, italicized portion of the response here, which begins UI states that now holding that and taking a look at 562, OCC 562. OCC 562 mentions approximately $3.8 million in improvements, leasehold improvements, time of purchase $2.2 million, and leasehold improvements after purchase of $1.5 million. What did these improvements consist of?
So generally, that particular building, as I had mentioned, was first occupied back in the early 90s, and it was no longer meeting the needs of the company given the size of our electric system and the Department of Electric Operations. As Mr. Eves mentioned, we had moved some of our support personnel like engineers and project managers to basically across the street at Armstrong Park. Improvements had been made, and perhaps Mr. Eve, you could recall some of the specific items to upgrade, I believe, like some of the technology and some of our telecom infrastructure within the building, some of the physical layout of the building to best accommodate the workforce that we had, things along those lines.
What I would like is if you can, I assume the company has a listing of the improvements that were performed, at the time of purchase and after purchase, in the two amounts that we discussed here on 562. If we could have an itemized, itemized listing of what those were.
Sure.
Okay.
And it's late file exhibit 30.
I mean, again, to the extent those are already in the record in 05, 06, 04, or 2008 rate case or others, we'll just pull that. We will look for anything that's most helpful.
Perfect. Thank you. So OCC 566, if you turn there, please. And these discuss revenue requirements for the Bridgeport Avenue property from 2012 through 2016. And it's about a $6.8 million cumulative number. These amounts would not have been contemplated in the 05, 06, 04 net present value analysis. Is that correct?
Mr. Buckley, I'm not sure I understand the question.
Yes. So it was presented to a net present value analysis was presented in docket 05 to the authority, which created a net positive value to ratepayers. Subsequently, revenue requirements associated with the same property, I guess I'll characterize it due to not selling the property, maintained in customer rates. Those rates that customers paid for the subsequent years would not have been reflected in the 05 docket. Is that correct?
Well, I would say generally, and I would defer to the company on any specifics here, but from the perspective of the net present value analysis in 2005, that would be a reflection of anticipated future costs or benefits brought back to the present time based on what was known and knowable at that time.
So unless the company knew that it was going to remove this property from rate base in 2015, it could not have included those in its net present value analysis. Is that correct?
Well, I wouldn't say it could not have. I think if the sale of the building was part of the plan, then certainly that could be incorporated into the 2005 net present value analysis. Again, I don't know if the specific dollars that played out over time would have been reflected.
Right.
Well, I could perhaps just follow up as well, Mr. Bacalina. When we produce the assumptions, I agree. It will not have shown that we were expecting to have that particular asset in our rate base into 2015 timeframe. However, I would note at the time when decisions were taken, we made prudent decisions and investments with the best known information at that point in time, and we presented it here to the commission, and that was reviewed thoroughly and ultimately approved as well. I would highlight that many assumptions would be different as you look back, and many costs would be different, this being one of them.
Okay, thank you. Sorry to keep flipping back and forth, but OCC 139, is it, it does reference 566, and the question was prior, what was included for Bridgeport Avenue and revenue requirements prior to 2012, and I believe the company's initial response was on OCC 139 that the request, yes, provide the annual amount of expenses by type associated with owning the property for each of the years the property was owned that were included in utility rates. And the response was that the requested information is not readily available. However, the company is gathering requested information and will supplement. So I'm looking at the supplement here, and it says that you have information from 2012 through 2017, which is, I believe, 566. However, Anything prior to that, which goes back to the 05, 06, 04 or 08, 07, 04 docket, the company does not have information on that. I just want to make sure that's where we've left off on this response and I haven't missed anything.
If you could just give me a
Dates.
moment to catch up with you. I'm
Sure.
relying on Mr. Eves to open up the various files, and we'll just give me a moment, please.
Almost done.
Thank you. Thank you. Just refreshing here and looking at the supplemental response to OCC 139. And I just want to clarify, because I think I followed your
Yeah, I can restate it.
questions.
I can restate it.
Okay, why don't you start there and then I'll
Yeah,
see if I can respond.
essentially the company does not have information for the revenue requirements associated with 801 Bridgeport Avenue for the period prior to 2012.
So, and in reviewing the response here, and I understand that the nature of the question was specific to the amount of expenses detailing out what is associated with 801 Bridgeport Ave at the granular level. And so our response stands that in 05, 06, 04, and in the 08, 07, 04 dockets, those were embedded within each of the SFR schedules that they would have been applicable to. If we had property taxes, if we had property insurance, if we had maintenance, it would have been in the C 3.0 schedules and all the external services associated with servicing that building, the depreciation, the rate base, all embedded within the various SFR schedules. Pulling that out for the single unique asset of just 801 Bridgeport Ave is not readily identifiable in that 05, 06, 04, and 08, 07, 04 dockets based on the filings that we have. Looking at maintaining historical records that go back that far, that's beyond the required retention periods. We do not have that type of asset specific detail, but rather, as my testimony would be, it's fully embedded within the dockets referenced.
I'm sorry, just a clarification, but beyond who's established record retention, please?
For the, as I understand, and I'll defer to the panel here to help me as well, with our SEC records retention policies, for purposes of maintaining our plans, effectively like a budget, because that's what would have gone into the development of the revenue requirement. It's my understanding that it is a 7-year records retention policy under a SEC requirement, but defer to my colleagues.
Okay, but if a company is out for longer than 7 years, the justification for the prudency of such expenditures, you're not suggesting that the SEC's retention policies override our duty to evaluate the prudency of the expenditures.
So no, I am not suggesting, just want to answer that the way you phrase it correctly, Chair. So I agree. So no, I am not suggesting that. Rather just clarifying that when we would have submitted and had all of our case development information for the 05, 06, 04 and the 08, 07, 04 dockets, the supporting detail would have been long past that point of time in which the plan data, the forecasted data at that level of detail, the granularity of it, would be available to us in the manner in which the interrogatory was asked.
Okay, and based on the SEC's retention guidelines is what you're.
That's how the company follows, let's say the maintenance of our detailed budget or detailed buildup of what we would operate under from a plan perspective would not generally be available going back that far.
Going back past the SEC retentions guidelines of 7 years is.
And I only pause for a moment to say that there could be instances where we have hard copy documents that may still be in some respect relevant or defining what is in a plan. We wouldn't have the ability to go and get into a system to be able to bifurcate and sort of analyze at the level requested here to produce that type of detailed breakdown.
I understand. Thank you. I think I'm asking, generally speaking, are you suggesting that the company, and I'm not sure if this is for Ms. Thieberger or not, but are you suggesting that the company does not maintain detailed records going back past the 7-year retention policy of the SEC? Or are you speaking specifically to this instance?
So, and I'll look to get a clarification my colleague would like to provide. Speaking specifically here with respect to one asset and all of the information related to that one particular facility at the time, the company, clearly maintains all of its detailed records for the actuals and what has occurred going back many, many years, as we've demonstrated here. The buildup of the plan information is what I just clarifying is what I'm specifically referring to.
Thank you. But is it a departure that the company does? What I'm trying to understand is it a departure that the company does not have the plan data for this asset? Or are you saying that for assets that are older than 7 years, the company does not retain the planning data for those assets?
So, to my knowledge, we have all the details from an actual standpoint. We don't necessarily have the forecast that was developed for an individual year that would have moved, been part of your budget. I'm just trying to understand.
I'm trying to
correctly budget and forecast, which is different from our actuals.
Okay, so would you agree that one way by which to evaluate the prudency of an expenditure is to ascertain whether it is over or under, the actuals are over or under what was forecasted?
Correct, when you're looking back through a forward-looking and prospective rate making.
Okay, and the company does not have the planning projections here because they're older than 7 years.
So just to correct myself, generally speaking, that's how I understood Mr. Bacalino's question for this particular facility. It's, to my knowledge, we do not have the forecast of the expenses that were related to the development of the revenue requirement back in 2005 and back in 2008.
Okay, thank you. Mr. Bacalino, please proceed.
Thanks. So even though OCC 566 goes out through 2016, the company still had expenses up until the time it was sold. This Bridgeport Avenue property was sold in 2018, correct? And I'll let you answer that.
Yeah, correct. There would have been minor maintenance
Okay.
and upkeep expenses.
And there are amounts, albeit minimal, I think. Well, I'll ask you this. Is the only thing included in this rate application associated with Bridgeport Avenue, the energy and delivery expenses that show up on Schedule C 3.11?
Reference Schedule C 3.11
Yeah.
WP line 13, which is titled Engineering and Delivery Bridgeport Avenue. So this could have been presented more clearly, but we explained in a data request response, and please forgive me for forgetting the reference. This line actually does not flow through the revenue requirement. This amount, if you combine it with the amount in the row above, is exactly offset by numbered line 16 on the schedule, engineering and delivery environmental cost provision. And we explained in our direct testimony why we presented it this way.
Okay, thank you. With that being said, there are no costs in any of the schedules here that reflect ongoing activities of the 801 Bridgeport Avenue.
Correct. The only Bridgeport Avenue related amounts we're seeking rate recovery of in this proceeding is the regulatory asset.
Okay, thank you. Going back to the lease and the decision that was made at year 10 to buy the property instead of continue leasing. What other expenses would the company have had at that point aside from the $3 million annual lease? I'll refer you to OCC 170, the last sentence here on OCC 170. The alternative to purchase of the property was for the company to remain as a tenant in a facility at a lease of $30 million over the remaining 10 years. So it appears that the costs that you were considering were the $3 million. And my question was, were there any other, was that all inclusive?
I think the nature of that response was specific to the purchase, as I understand it, the purchase versus an ongoing lease. Things like leasehold improvements, which would have happened under either condition, whether you own the building or continue to lease it. So I guess clarify that I think in respect to a purchase versus lease analysis, then that 30 million is comparable. Top of mind, I don't think of any other differences for ongoing maintenance and capital improvements, whether you own it or lease it.
Okay. On page 32 of the revenue requirement panel rebuttal, let's see here. Line 10 starts, this was with respect to the Bridgeport Avenue. I believe costs we're talking about here. This was all fully contemplated, analyzed, and supported as part of UI's rate cases in 2005, 2008, 2013. Therefore, the regulatory asset is appropriately reflected in the revenue requirement in this case. Now, would you agree that this is the first case where actual costs are known and compared to the estimates that were assumed in all of those previous rate cases?
Mr. Vockley, could you just be a little bit more specific when you say
Yeah.
all costs?
Sure. So when we talk about assumptions that were made in net present value analysis, sale of the Bridgeport Avenue property, continuing revenue requirements, things of that nature. Those could not have all been contemplated in any of those 3 decisions. Is that correct?
I think as a general premise, I would think because we looked at this issue carefully, and it's a heavy amount of discovery on it. There are really 2 key decisions involved in the decision to sell Bridgeport. One was the decision to own, not lease, and the company, and we've explained certain benefits of that were factored into the company's analyses at that time. And the other key decision was to centralize and consolidate. And so the sale of Bridgeport Ave was all part of that larger process. And again, as it relates to the specific regulatory asset, I come back to those 2 decisions. And when we speak about them being considered before by the authority, and in the rebuttal testimony, it's really reviewing those decisions, determining them to be reasonable, and authorizing the company to move forward in certain directions based on those decisions.
Okay. OCC 169. There, please. This is another net present value analysis submitted in docket 130119. Again, this is a 20-year net present value. Is a 20-year period customary in evaluating the economics decisions such as this, the Bridgeport Avenue sale?
I'm just reviewing the response.
Sure.
My recollection is the company testified in that docket that 20 years was the customary length of time for analyses such as this.
Okay. So similar to the 05, 06, 04 docket, we only have a sheet here that gives one number when comparing what the net present value is. And so what I would ask for is the backup to what we're seeing here on OCC 169, page 9, as it was filed in that the 130119 docket. With we would have all the assumptions and things of that nature. And
the company provided that in response to LCG 12 UI attachment 1 in that docket, and we'd be happy to provide a copy of that response as a late file.
Okay, thank you.
Okay, so late file exhibit 31 is to provide.
That's a present value analysis from docket 130119 Bridgeport Avenue.
130119.
19. And there would have been an estimation of loss for the Bridgeport Avenue property in that analysis?
There was.
Okay, and that'll be reflected in the late file exhibit when we take a look at that. Okay.
It will. There are a number of columns for the various components of the calculation, one of which is depreciation and ESWC, regulatory asset amortization.
Also mentioned our $7.2 million in annual operational savings. And that's on page 11. That goes into the revenue requirement, the net present value analysis. $600,000 annually. How have these materialized compared to this 13 docket compared to the what we're looking at here in the company's rate request? These particular items, I believe you had them itemized here. The $600,000 goes to items such as warehouse staffing, parking, mileage, inventory levels, and things of that nature. What is actually materialized, and how have we seen those flow through into the company's revenue requirement? And if you could point to specific areas within the company's application where I could take a look and see that for myself.
Were you reading from a document? I just want to make sure we.
Yes, I'm still on 169, OCC 169. It's page 11. And
Our response to OCC 169 is a single page.
attachment 1, sorry.
Oh, okay, thank you. We're just going to review that.
Mhm.
You referenced page 9 of attachment 1.
So the that page 9 was the net present value analysis itself that we're going to get in late file exhibit 30. The page 11 is the $600,000 or $7.2 million in operational savings that were included in the net present value analysis. And the question is, are we going to get the level of detail there that's going to support that? And also, if the company can point to its present application where we can see those benefits actually materialized and flowed through into these expense items.
Mr. Bacalina, associated savings associated with these areas would be effectively what's not reflected in the revenue requirement. So the revenue requirement we represent would be net of any of these associated savings or efficiencies. We have not done an analysis to pro forma the revenue requirement, assuming there was no sale.
Okay. So looking, I guess, okay, so I mean, there was no sale. Okay, I'll leave it at that. If you were to take these specific items when the company was non-centralized and compare them to now, would we see, inflation adjusted, I suppose, would we see the $600,000 or $7.2 million over a 20-year on a net present value basis adjustment flowing through to customers?
Just going to confer for 1 second.
Exactly.
Sorry, thanks for your patience. And just to make sure I respond to your question, would you mind just rephrasing or re-asking it?
Sure. If you had gone, we take a look at what non-consolidated operations look like compared to what they look like presently, would we see these, that these annual direct savings have actually materialized? And if so, where would we see that in the application?
So I would defer to the company on the materialization, but my understanding is that the savings as anticipated, or that its types of savings anticipated have been realized. To prove that out would be has not been done. There's many intervening facts over the years that that would sort of muddy the waters on such an analysis, and that these specific amounts haven't been tracked through the system, for instance. Again, it's a pro forma, so it's what didn't happen. So in that respect, there's nothing I can point you to specifically in this revenue requirement.
Okay, thank you. So last area I have here are the carrying charges, and the annual amortization, as I understand it, is essentially based on it's a 3-year amortization based on the company filing a 3-year rate plan. Is that essentially the justification for amortizing these over 3 years?
Yes, as Mr. Hurwitz said, for the majority of regulatory assets, we've aligned the amortization period with the rate plan proposed in this case.
Okay. Now, in EOE 186, the company did not originally record carrying costs, and I believe it was until the first quarter of 2022. Is that correct?
Correct, as described in the company's response to EOE 186.
Okay.
Carrying costs were recorded in the first quarter of 2022.
And this is while preparing for the rate case. Did the company identify this?
I don't recall it being linked to rate case preparation.
Okay. So essentially, the carrying charges, 2022, for lack of a better word, were backdated from 2022 through 2016.
That's the calculation we've done,
Okay.
correct?
So would it be regular practice to review regulatory asset balances internally as well as with external auditors on an annual basis?
I'm not part of the company's conversations with its external auditors, but I understand that these balances are regularly reviewed.
Okay. And in the company's response to OCC 551, points to instances where the company, PURA has, make sure I have the correct. PURA has allowed for carrying costs on, in particular, dockets. However, the company has not been able to cite anything in the dockets related to Bridgeport Avenue that allowed for carrying costs on those balances. Is that correct?
Yeah, we looked very hard for documents either explicitly authorizing or precluding the inclusion of carrying costs, and what we found was a number of examples of carrying costs being allowed on various regulatory assets, and we summarized many of them in this response. But correct, we could not find something either explicitly authorizing or precluding the recovery of carrying costs on Bridgeport Avenue.
Okay, thank you. Those are all the questions I have.
Okay. I'm sorry. Were you?
I was just going to add to that. And just in terms of the accrual of carrying charges on this asset. So if we think about what would have happened had the company continued to own the asset and used it, it would have been in rate base earning a return. Instead, the company put forward a proposal that was approved by the authority that provided benefits to customers. And so in this now different scenario where the company has sold the asset, it continues to accrue carrying charges, understanding that it's it committed capital has not yet recovered the revenue associated with that investment.
Okay.
Benefits to customers that you're not able to quantify, though.
Well, the company has quantified those in the past. My point was that sitting here today, we haven't shown the revenue requirement grossed up for those savings, for instance.
All right, thank you. We are going to take our lunch break. We will come back at 1 p.m. and we will resume cross for this panel with the Office of Consumer Counsel. Thank you.
Have a good lunch.
Okay. You want me here after?
Right.
Okay.
Have a good lunch.
All right.
Hi, Teresa. Here she is. Popping right in here.
Yeah, so I couldn't get onto my email computer to click on it. I tried using the Outlook, but Outlook wasn't working this morning. So I ended up.
We do your own.
Doing my own.
Okay, because I got the invite. So.
Yeah, then I made you
Yeah,
post.
so I'm gonna get stuff. No, wait a minute, I'm not here. Okay.
John Trainer was.
Like whoever's here tomorrow. That's me.
Statewide issues this morning.
I saw an email.
Yeah, so.
I have no idea.
They have. They flip over.
So whether it's tonight or tomorrow morning. I have that PSRB job.
Yeah. Did they confirm?
All right. I think so, because she's, Vanessa sent me an email.
Oh, okay,
yesterday, But I will check, if not.
Feel free to come back.
I got
Sorry.
another.
No, take your time.
Now, I'm just. If I want to purge this disc on here.
Yep.
There's a way to do that, right? Because I don't want.
You don't want to save
files
it.
on. No, because I do real time and I save.
Oh,
it on
yeah,
my
so then you
computer.
can, yeah, I do that too, but I'm always
Yeah.
I'm so afraid that if the one time I go to delete
Yeah.
that, it's gonna be
I mean,
like,
hold a bunch.
yeah,
right?
that- yeah.
All right, so at the end of the break case, I'll
Yeah,
ask you again. I really need
Yeah,
to
no,
watch
you
the
just go into,
tutorial.
you just go into, I think
More?
it's more, yeah.
Okay.
And then you can format your SD card.
Just like we're switching, you're switching.
Are you the afternoon shift today too? Look at you.
Not that I didn't want to be with you this morning, but you know. Things come up, right? Things come up, life happens. You gotta take care of business. All right. So, certain things. Yeah, we have a new. And they're going. They got it. I'll text you.
Okay. So when we come back from lunch, we're starting with OCC.
Yes. Attorney Venora? I just closed out my computer. Mr. Donnelly, what's his first name? It's Kevin Donnelly, Donnelly. All right, he's the new, thank you. He's the new witness here. Okay. So there, yeah, she's still there. Kevin, so Kevin. Okay. And he doesn't have a card. He's right behind Adam. Okay. Yeah, so.
So we're starting with OCC then.
Yes. OCC. So yeah, so tomorrow will be my O&M panel. Never. Oh. There's the one sitting behind. Yeah. Oh, yeah. So yeah. So so everybody went, I think about it. Yeah. Karen was like, oh, you'll be through that one. And it's next one. You're fine. I'm like, you'll be fine. You're probably not even gonna finish. It's fun. That's like never the way it goes. Oh, believe me, at least I'm not you. Up all night. Yeah, I was like, I just can't. I won't be able to get. Well, the problem is that I can't stay up all night. So like, yeah, I did sleep for like 4 hours, and then I'm like, I got up and I'm like rushing to get it done this morning. So that's why I'm like, I was running late. I'm like, and then literally, whenever I walked in and the doors are shut and they're talking, I'm like, oh my God. You thrive. I got here. Not really. I was like, oh my God. I'm like, I got here late. They already started. All right. And then Vice Chairman left. I saw him walking out. Yeah. I said, you mean you're not going to stay for the rest of the day? He's like, no, I'm going to be back tomorrow. I'm like, okay. He goes, but you have fun. But I will, when I get the transcript, I will tell you. Did they pick a date for that? Yeah, they did. Okay. I think they're already scheduled for the 8th. Of March. But I will, I will. You always are so good about filling me in. So they're gonna just go to have the Wednesday after. Yeah. So they're using my plug here. Yeah. It was. Oh my gosh, it was so funny yesterday. They had their stuff plugged in too, and Kaposi was like, oh, is that plugged in? I'm like, yeah, it's all plugged in. He's like, oh, okay. He's like, well, that's weird. He's like, it's not charging. Thank God he said something because the strip was off and my computer was plugged into it too. Please. And I didn't even know. I can't. I was like, oh, thanks for saying something. I'm like, because all of a sudden it would have been like, oh. I mean, it would have only been a click of a button at that point, but I was like, oh. So yeah, but there's just so much room for error. Yep. I'm like, because my luck would have been like, it would have given me no notice and it would have just like shut off. That would have been my luck. Look at you. You didn't break yet? I was. Want me to answer that? No, I'm all set, thank you. I asked the little guy in front, I'm like, they didn't take a lunch break yet, did they? He's like, I don't think so. I'm like, that's not very comforting. I'm like, I need like a definitive answer. Well, I guess they say they can't go past 5:30, so. Oh, I guess I have the machine. Only if you want to take it home with you. Brenda busy? Honestly, I think she is, but I haven't talked to her since it all started. I really haven't talked to her because I'm like so busy. So I'm like, oh. But I'm assuming she is. So you're gonna be so sad if you don't have to come back here tomorrow. So do you want me to, if it does cancel, you want me to say something? Yeah, if it does, yeah. If you really don't want to come, I'll come, obviously, but. No, it's half. I have time to get it out. Yeah, Robert lucked out not yesterday. Because they lost power or something, he told me. Well, they had no internet on Tuesday at all. And then one of the panels, so my witness yesterday for NECTA was supposed to be there on Tuesday evening, but then she wasn't here. So Robert left at like, I think they ended at like 3:45. I was like, oh, you're so lucky. Well, maybe he wanted the pages. I don't know. Well, that's true. No. He's so funny. He's like, I never really like talked to him, but when he came in, I asked him like about his mask stuff and everything, and he was telling me all about it. Oh. Yeah, he's good. He's solid.
Yep. All right, my dear. Enjoy your ride home.
It wasn't too bad once I hit Connecticut, but Mass
really?
was pretty.
Right, yeah.
Yeah.
Oh, well then if is it supposed to be?
I think it's gonna be all right.
You know what, I think she just said your job was confirmed, because I did ask her,
Oh,
I said,
okay.
is there any chance Lisa could come in the morning? And she's like, no, it's confirmed. I'm like, okay. So, but so now you don't have to drive anywhere, right? Or
Yeah,
they're
because
doing,
they have not been getting out on time either.
oh, really? But they're doing their stuff by Zoom, right? Or whatever team.
No, I go there.
Oh, you do?
Yeah. I go, you know why I go there? Because it took me forever to get the transcript. I spent all weekend on it.
Oh,
because
really?
I couldn't hear what you were
Oh,
saying.
yeah, that's the only, and the thing about them is so when they, or I don't know if it was them that first started, it was them or if it was the other one, the other board, they were doing it on the telephone. I'm like,
I've never
if you
done
guys
that.
are gonna do this,
You
I
always
think it was
go
the
first.
nursing, I think it was the nursing board
Oh.
actually. But I'm like, if you guys are gonna do this, everyone really
Yeah.
needs to use Zoom because
Yeah, it's
everyone's
not
like
hard.
talking over each other, and on the phone, it's even worse than Zoom is, because at least you know when someone else is, if you're talking over each other on the phone, I don't even know that you're even trying
No.
to speak.
No,
So I can't stop anybody.
Yeah. Yeah.
So,
Yeah,
That
so
was
that's why I go in person.
yeah,
Wouldn't rather stay home.
right,
but,
yeah.
it's
Where do
just
they hold
never-
those?
At, in Middletown.
Oh, okay, all right.
Yeah, so
Yeah.
it's kind of a hall for me because it's not, anyway, I wanna bore you. What is that? No. It's here, is that, oh my God, is that my thing? What is that?
Oh, was it the thing that goes in there?
It must be a book. Oh, okay.
She's like, is that right?
All right, I didn't leave it, right? Okay. Yeah, so it's kind of,
That is a little far.
yeah, I mean, it's not, I'm not complaining about it.
No, yeah, yeah.
No, I'm happy to go, but,
Right.
it's so much better now. I mean, it's still hard to hear in that room. The acoustics
Really?
are horrible.
Yeah.
But
always
at
tough.
least.
But at least you're not on
seeing
Zoom. Yeah,
people I know
right.
talking.
Yeah. So is everybody there, or do they still do other people remotely?
Everybody except for 2 board members.
Okay.
And actually, I can hear them pretty good.
Oh, good.
Because early in the pandemic, I did
Yeah.
go. And I couldn't hear who was on
Yeah.
remote.
Yeah.
But now they fixed whatever they had to fix.
I had a hard time with them when they were, when they had everybody in one room, like they had like the counselors and like the one patient, and they're like all of them are talking in the room. So then it's like, if you guys are all gonna talk in the same room, I need you to identify yourselves. And they were like, okay, but then everyone like that, they do that for like the first couple of times, then everyone falls off. So then you kind of have to be like,
Yes, one room.
yeah.
And then, I was set up, somebody told me to sit, where to sit.
Yeah.
First time I went there, so I said, okay, it's all set up, it's a big.
Oh, yeah, yeah.
Get organized. And then someone comes up to me, oh, the Quiddy's gonna be sitting right next to you, you don't mind that, right? I said, no, I do.
She's like, actually, I'm gonna move now. Just saying.
They said it jokingly because they knew I.
Right, yeah.
Good ideas.
Obviously.
All right, thank you.
All right, have a good drive and be safe going home. It should be good now, but I said it should be good now, but be careful going home. All right, goodbye.
Okay, Attorney Lenore, did you want to try any read-ins or shall we proceed into cross?
Yes, Chair Gillette, we're prepared to provide read-ins C, D, E, and F. I'll start with Mr. Kleza. Mr. Kleza, were you able to get information to respond to read-in C?
I was.
Please provide that at this time, please.
Yes, thank you for the time to get that accurate information. The first lump sum request for proposal was issued in July of 2016 and awarded in September of 2016.
Okay. All right, thank you.
Okay.
Mr. Dane, I think, do you have the response for read-in D?
Yes, the question was whether prepayments were included in the lead lag study. I confirmed with Mr. Adams that they were not.
Thank you.
Thank you. And then read-in E, is that you, Mr. Hurwitz?
It is, and there were a couple of different components of that regarding accumulated deferred income taxes. The first, just to clarify, NYS does stand for New York State, and it appears in UI's trial balance because UI shares account numbers with New York, but it's not mean that there's a New York State recovery component of this. There was also a question about whether a certain balance we were pointed to Excel row 422 of OCC 79 UI attachment 5 and whether that related to protected or unprotected deferred income taxes. The answer is that relates to both protected and unprotected deferred income taxes. And I believe the last ADIT related component of this read-in was regarding line 425 of that same attachment. This is not a part of the ADIT offset to UI's rate base. This amount relates to the investment tax credit. Including this amount in UI's rate base would violate federal tax laws, and company witness Dave Bieber is here to discuss that in more detail if that would be helpful.
Okay. Thank you. And lastly, do you have information to respond to read-in F?
We do. During the break, we found late file exhibit 58 in docket 050604, which requested an update to the ESWC appraisal. The response indicated that the verbal update discussed during the hearing confirming the value of ESWC remains in the range of 8 million was from UI's real estate strategy consultant and not the appraiser OR&L. This estimate reconfirmed with the consultant on October 18th, 2005.
Okay, thank you.
Okay. Very good. I think we are ready to begin cross by the OCC for this panel.
Thank you, Madam Chair. Good afternoon, panel. My name is Tom Wheel. I'm a staff attorney with the OCC. I'm joined by my co-counsel, Attorney Minikowski, and we're going to start with cross from Mr. Schultz, who's our consultant in this case.
Good afternoon. I'm going to follow up on Mr. Vocalini since we're cross, because that's kind of fresh in everybody's mind, I hope. And I can wrap it up a little real quick on that. When this purchase was made, the purchase of the property was made, who makes that decision? At UI.
In terms of the decision and the purchase, as I previously testified, our former president, Mr. Tony Valillo, was at the head of that conversation as our chief executive. Other executives were also involved, as well as our UIL CEO. At that time, it was Mr. Woodson. In 2006, Mr. Torgerson became the CEO of UIL. So there were various senior executives that were involved. I do not recall if this was ultimately presented up to the board of directors. My sense is that it would have been, given the governance and the size of the purchase.
Okay, that was actually the pretense of the question, to see was the board of directors ultimately the deciding factor.
Yeah, sorry for interrupting, Mr. Schultz. They should have been, and I believe they were. From memory, Mr. Valillo Mr. Woodson and then Torgerson and the board of directors.
Thank you. Would you agree that the commission approval that you've referenced in your discussions on the sale of Bridgeport, that approval is basically the result of the presentations that was made to them by the utility itself?
Yes, back in that, again, time and timeframe, we did the analysis. We presented all the information to what was in the DPUC, now PURA, and the commission supported that purchase and moved forward with the construction of central facility, ultimately approving it, as well as the sale of 801 Bridgeport Ave. At the time of those decisions, it was with the information known and what would a reasonable person would make and take as that decision at that point in time.
When the net present value was prepared for at the time of the purchase, was a cost assumed as one of the factors in that calculation of the net present value?
To clarify, Mr. Schultz, are you referring to a cost related to
the cost to acquire the Bridgeport property? Yes.
So then I just want to make sure I'm answering your question. The cost to acquire was really considered as a result of the net assumed loss that would have been a result from the sale of the building. So we had the cost to acquire it, the 16 million, a few leasehold improvements resulting in a net book value of the 20 million versus what was analyzed and looked to be the eventual sale of that building, and that net position, the net loss, was factored into the net present value analysis.
Okay. You mentioned the 16 million. So the 16 million would have been the factor that you had put into the net present value calculation as the cost to the facility?
From recollection, and we'll go back again to all of the documents and docket 050604 to provide the assumptions and information, we would have factored in the assumed or net present value calc would have incorporated the net book value, which involves the purchase price aforementioned.
Okay. Did the Bridgeport facilities provide any actual benefit to customers during the years 2016 to 2022?
From a perspective of benefit to customers, the company had removed, as previously testified, that particular asset from the utility accounting. It was still available if we needed to utilize the parking lot for lay down or in the event of a severe storm, which we did not have any such need during that time frame prior to the actual sale. We would have had that space, that facility, that location available to us. It was not utilized to the best of my knowledge prior to the sale in 2017. From 2016, just to rephrase your question, from that period of 2016 to when the sale happened, it was not utilized for that purpose.
And I believe it was Mr. Hurwitz was referring to the Bridgeport property being removed from rate base. I just wanted to clarify, when that entry was made, when was that? Was that an entry made as part of an entry on the books of UI, or was it just a format entry made just to remove it from rate base?
I think you're conflating two separate actions taken by the company. The first was, as we described in the 2013 rate case and have reiterated in our testimony today and in our written testimony, there was an adjustment to the revenue requirement reflected for rate making purposes effective January 1, 2015 as part of the 2013 rate case. Separately, there was an entry to reclassify the property on our books from utility property to non-utility property in the 2016 timeframe. I don't recall exactly when in 2016 it was.
And the property was sold in 2018, correct?
correct in that timeframe. I don't recall the exact day.
Okay. Is it customary for a loss on the sale of non-utility property to be charged to ratepayers?
That is not a customary treatment on the loss. That's why we explicitly included it as part of our NPV analysis, sought support and recovery of that when we first presented in docket 050604, again in 080704, and tied the ability to move towards and into a central facility for the benefit of our customers with the ability to recover that loss on the sale of 801 Bridgeport Ave.
Okay, that's all I had on the Bridgeport then. I want to switch to capital expenditures. Mr. Ives, is it Ives? Eves?
Eves.
Okay.
Like Christmas.
In your direct testimony at page 6, lines 3 through 4, and you make reference to table CGE 1, I believe. Is this table a listing of all the projects planned for the 3-year period and after that?
I'm sorry, I jumped a chart, CJE1. Let me get the table CJE1. So table CJE1 is a grouping of the projects by category, looking forward over the rate period.
Okay. And when you're developing these costs, are all the external costs of the projected additions listed on this table supported by written estimates and or quotes from vendors?
Not for all, no.
Are some of the external costs for the projected additions supported by written estimates or quotes from vendors?
Depending on the engineering, the phase we're in with the engineering design, they would be. But looking out at a time frame that long, we would not, have done full engineering, full procurement on everything in a 5-year horizon. No.
What about the 2023? That's not that far out.
I mean, there in the customer category, as an example, that there are customer jobs that have already been, initiated and designed, and there are things that will come in the middle of the year that have not. So we look at for customer work, we would look at a historical projection to establish the budget, and then as the work came in, we would design it to try to meet the timeframes necessary to meet the customer demands. So it's a rolling process generally.
If you could, I'd like you to look at the response to OCC 193, please.
Okay, I'm there.
If you could read the question and answer before you answer this. Are you aware of whether any supporting documents were provided as an attachment to this response?
The question is, am I aware of any supporting documents that were provided as an attachment to this response?
Yes.
I don't see an attachment to the response, so I don't believe there were.
Okay, thank you. The last sentence on there makes reference to a PPM tool. You see that?
Yes, I do.
And does this PPM tool that you're referencing provide a summary of cost detail for the projects?
Within the PPM tool, We use this to track the various project approvals, and they do contain cost plans associated with the capital expenditures forecasted for each project.
Does it provide, does the tool itself though provide a breakdown of the cost for the ultimate, cost components for the ultimate cost that's being requested for a certain project?
There are breakdowns by resource type. So these would be classified as, internal and external labor, materials.
Exactly. Okay. I'd like you to look at the clean energy transportation panel exhibits, CETP 2, 3, and 4, if you could. My question here is the detail that you're seeing reflected on this document. Is this detail similar to what you would find in the PPM?
This is a template for a project that was created specifically for those projects. Some of this data would be included within the PPM tool.
Is a document similar to this generated for the distribution capital expenditures?
We have within the system the information that is relative to this to capture the project information and facilitate the approval process. So some of those approvals are through an automated workflow. So it doesn't output a standard document template, but rather it sends the link to the actual project data and structure and project document within the system. But there's not an exported document in this format.
I'm sorry, I didn't catch that last sentence. There's not
an exported document in that format. An exportable document.
For the distribution capital projects.
Yeah, for all of the projects. This was compiled manually.
Oh, okay. So this isn't a document that would have came out of the PPM on a project. Have you provided any documents out of the PPM that you would get as a result of summarizing what costs were in a project?
The information relative to the specific project that's standard across all projects within PPM is within the system itself. So the intent of the system is so that the information is captured within there and the approvals can be processed through an automated workflow. As I mentioned before, there are steps where we need to administer some approvals external to the system where we export certain data, but there's a lot of manual interpretation to be able to facilitate that.
I guess the thing I'm trying to get at is the PPM is what you're relying on to generate your project costs. Am I correct?
It does not generate the project costs. It is the area where the project managers enter their forecasted project cost plans that can be utilized for processing approvals.
Okay, so but all the projects that are in this rate case, would you consider them supported by the PPM document, the information in the PPM?
Yes, they have associated cost plans as well as relevant project data within the system relative to many of, but not all of the items that are in this document here. Project description, project manager, total dollar amount.
So when a request is made for supporting documentation for project costs, would you feel that a printout of whatever's in the PPM would suffice in providing documentation to support that project?
That depends on the nature of the project and the level of detailed information that's desired.
Do you consider the costs that are within the PPM to be known and measurable costs?
The costs that are in the PPM system are forecasted project costs.
But do you consider them to be known and measurable as support and for your project costs that you've asked in this rate filing?
I weigh in and then ask my co-panelists to add on to my answer. In our view, there's two components to known and measurable. There's known and measurable, and we think there's no question that the plant additions reflected in our revenue requirement are known. We're a utility. We will, no question, need to continue investing in our system throughout the rate years. And then the second half of that is whether it's measurable, and we've taken a variety of steps to measure the level of plant additions that will be required in the rate years, one of which is conferring with our colleague, Mr. Eves, and all of the people who support him to understand the needs of the system throughout each of the rate years, and he's testified at length about that. We've also considered the company's historical experience. We presented evidence about that in our revenue requirement and in our testimony during this hearing. And in our view, those things combined mean that the answer to your question is yes, the plant additions reflected in our revenue requirement are known and measurable. And I'll just check if any of my co-panelists have anything to add.
Does UI have a document that defines what is known and measurable in establishing the costs that are put into your PPM, your plant forecasts?
I think there's two parts to that question, so I'd expect that Mr. Eves could weigh in and his support could weigh in on the PPM tool. I'm not aware of a document that explicitly defines the term known and measurable.
So our process for closing work to plant in distribution, typically is closing work orders. So these projects will be executed. So we'll take the example of a customer project. Work orders will be written for that customer project that will define the labor requirements, the material requirements. We will go and execute that work. We will bill out the materials to the work order. We will charge the labor to the work order. At some point, as it progresses through its life cycle, it will be closed and close to plant. And then that estimate could then be compared with the actuals that were attributed to it. And it will flow through our as-building process for record update and things of that nature. So that's in general how the work progresses from design, from conception. So at the beginning of the year, taking the customer category, for example, we will project an expected level of customer activity that's generally based upon historic performance with some understanding of what's occurring in the economy potentially. And then that will progress into customers contacting us meeting with them, writing work orders, and executing the process I just described, which eventually results in plant and service and assets going into rate base.
And if I could add to that, your question asked about known and measurable in terms of what's reflected in the revenue requirement. And what the company is requesting here is that the authority set a rate for a future period. And so it's important for the capital plan and the plant and service plan that we discussed yesterday to be as current as possible, understanding these rates will be in effect in a future period. So the company has put forward its projections of what those capital additions will be and when they will roll into plant and service. And that allows them, as part of a 3-year rate plan, to stay out of a rate case for that period, as opposed to if we limited the revenue requirement to just what was spent as of the test year or through the filing of this case or some other historical date, then the company has already been spending additional money to invest in its facilities and putting those into service. And so it would really shorten that period in which the company would have to come back, because it would be just unable to earn its return based on that, the fact that it continues to invest in the system.
Okay. Between the three, as I think Mr. Eves was talking more about after plant has been constructed, and Mr. Dane there, I was talking, kind of more addressed the fact that I'm looking at the costs that were put into the rate filing for the interim period, rate years 1, 2, and 3. And what I'm trying to get a full understanding of is when these costs are put together, is it done by one person, or are there multiple people that put together these cost estimates that is put into this rate filing?
Virtually all areas of the business are involved in generating this.
So my question then to you is, if you don't have a document that tells you what a known and measurable standard is and what is to be put in, what is known and measurable, and you consider that all the information in the PPM is known and measurable, how do they know that it's known and measurable if they don't have a document to tell them what it is? And that you're doing it on a consistent basis from one individual to the next.
You're applying the term known and measurable to the forecast data here, or to the plant in service in the past?
I'm talking about the interim year and rate years 1, 2, and 3.
Well, by definition, a forecast cannot be known and measurable, right? It's a forecast. It is what we see in the future. So we're projecting the company's needs to connect customers, to provide capacity, to correct reliability based upon our projections for the future.
And if I could just add to that, the process we've taken now that Mr. Eads just described, in our view, is consistent with the process taken by the company in its last several rate cases and the process taken by other electric and gas utilities in the state of Connecticut.
Well, the one point that was made there is that a forecast can't have any information that's considered known and measurable. Have you ever testified in any other jurisdictions besides Connecticut?
I have not, sir.
Has anyone?
Yes, I have. I have as well.
Did they have a known and measurable standard in those other jurisdictions?
And I'm sorry, just before I answer that question, Mr. Schultz, I think Mr. Eves is applying known and measurable from the perspective of capital planning. Mr. Hurwitz and I are focused on it from a regulatory perspective. But to your question, as to whether other jurisdictions have definitions of known and measurable, certainly it's a regulatory concept. It's typically associated with an historical test year cost of service. And known and measurable is a reference to the adjustments that are made to that historical period. Here, as we've discussed, the company is proposing a 3-year rate plan based on projections of capital and plant and service. And in the jurisdictions that have that historical test year with known and measurable adjustment, I don't have an exhaustive list of whether they've defined them or not. They may have in certain documents. It might otherwise just be generally understood by the parties.
I understand, as it's been explained, that you go out 2 or 3 years that you might not have the information. But let's look at the interim period. Would you consider the interim period a period of time that you could have actually had documents of quotes and estimates that would serve as supporting documentation for the projects that you had in the interim period?
We would have that. Yes, we would.
Do you mind if I revisit your question about other jurisdictions in known and measurable?
Sure.
The Maine Commission applies the known and measurable standard. For example, in docket 2018-00194, they said, quote, the commission applies the known and measurable standard. That commission's approach to projecting plant and service for many rate cases has been to consider the historical rate of growth in plant additions and then assume that that continues out through a forward-looking rate year, which is, as we've presented evidence in this proceeding, very similar to the approach taken by the company here.
Okay. On that, you stepped me up to a question I had for later, but I'll ask it now. If you looked at Schedule B dash 2.1A, please.
B-2.1A.
Yes, sir.
We're there.
See the column that says you're there?
Getting there.
You see the column that says interim period additions?
I do see that.
224,587,000.
On numbered line 32?
Yes, sir.
Yes, I do see that.
Okay. Would you agree that that's the same total that's in OCC 157?
One moment. In OCC 157 UI attachment 1, I see a total interim period additions number of 224,586,830. As well, it's presented differently. I agree there.
The same. Okay. All right. The interim period. Is that from January 1, 2022 to August 31st? January 1, 2022 to August 31st, 2023?
Yes, the interim period is the period after the end of the historical test year, but before the beginning of rate year 1.
So would you agree that's 20 months?
Yes.
Okay. If I was looking at the interim period additions for the 20 months and I wanted to annualize that, so it's only a 12-month figure, would you agree you divide it by 20 and multiply by 12, basically?
That would be one approach. We provided a version of one moment. We provided a version of Schedule WP 1.0A, which presents rate base by month that covers the interim period, so it would make that math unnecessary. But
well, generally
I agree that that would be one approach to annualizing this number.
And if you were to do that, would you agree, subject to check, that the annual amount would be $135 million?
One moment. I'd agree that $224,586,830 divided by 20 and multiplied by 12 is just over 134 million.
Thank you. And the rate year additions are basically all in the same ballpark of around 153 to 154 million dollars, correct? As shown on Schedule B-2.1A.
Could you repeat the range you just quoted?
153 or 154 million in each of the years.
On Schedule B-2.0A, the pro forma adjustment that I see is 142 million. On Schedule B 2.0B, the pro forma adjustment I see to get us to rate year 2 is 143 million. And on B 2.0C, the pro forma adjustment that I see to get us to rate year 3 is just under 142 million.
I'm talking about on Schedule B 2.1A.
I'm sorry. One moment. I do see numbers in the range you quoted on that schedule.
Okay. The numbers you were quoting would have been net of retirements, correct?
Correct.
And the numbers for the interim period that we were talking about earlier, that was the gross, that was not net of retirements.
Correct.
Okay, I just wanted to make sure we had an apples to apples
Nope, that
comparison.
was my apologies. I was looking at the wrong
Not a
schedule.
problem, not a problem. If you could refer to OCC 157, please. Already asked that and that. I want to get some clarification here based on the rebuttal testimony, Mr. Eves. And if you want to reference the rebuttal testimony, it was page 3, lines 1 through 20. I'm trying to get clarification here. In the attachment there, it's a column that says percentage to complete. You see that? Now, when you have a percentage to complete, is that percentage to complete in relation to the amount shown in the amount column? Or is that in relation to the total project cost?
It's percentage complete, not percentage to complete.
I meant
those would be
I'm
inverse.
sorry, yeah, percentage complete.
And I'm sorry, could you repeat the question?
Is the percent that's in that column, is that related to the amount that is in the amount column?
Percentage is based upon the percentage of the amount of the capital expenditure that's used and useful and being put into plant during the interim period relative to any total amount that will be put into service. So the total project cost.
All right, we're gonna take a project, for instance, that way I can make sure I get this, understand this. There's a project called 802.272.01. You see that? I don't have a line number, but it's
What's the name, sir?
L874 Raphael Network, Bolt Bridgeport. You see that?
Yep.
The amount here is 3,935,000, correct?
Correct.
Now, in the column that says percent complete is 19%.
Correct.
Is the 19% what's been completed of the 3,000,009, or is the 19% what 3,000,009 relates to the total project cost?
The 19% is of the percentage of the project complete relative to the total project cost, which for this project, we would have to refer to another schedule to confirm if the 3.9 million is the total project cost or just the plant additions for the interim period.
Our rate year 1, 2, and 3, do you have a summary that would be comparable to this for the plant costs that are requested?
So you would be looking for the plant and service forecast by project by calendar year?
Correct.
Yes, we could provide that.
Could I get a late file then for those projects?
Yes, so that we are up to late file exhibit 32, and it's to provide a project by project percentage in service for each rate year. And Mr. Schultz, can you remind me of the OCC interrogatory that you want it to look like?
OCC 157, attachment 1.
Chair, can we clarify that request?
Mm-hmm.
I believe what you requested was a rate base forecast for the 3 rate years, correct?
Correct. And essentially going back to Schedule B 2.1, for rate year 1, it would tie into the 153,340,000, rate year 2, the 154,662, and so forth.
So rate base forecast for the rate years, tying back to, I'm sorry, repeat that reference again.
Schedule B dash 2.1A.
Schedule B dash 2.1A, thank you.
Which is plant and service. Mr. Hughes mentioned rate base, that you want the plant and service.
Correct.
Right, okay, thank you.
Can you give me a definition of what the program ongoing costs are on this document?
I'm sorry, what are you referring to, sir?
OCC 157.
Yes.
There's a column, or it says complete question mark, and it says program ongoing for a number of these projects.
Okay. So there's 2 general types of work that we do. One is a discrete project, and the other would be a program that is continuous, and pole replacements would be an example of that. Where the program continues and puts assets into service over a continuous basis. So if we're building a substation, we would do the project, and when we put the substation in service, there would be one big in service milestone. For programs, we'd be putting assets in service at the asset level. So we wouldn't wait a year to close the assets to plant. If we were doing pole replacements, each pole or each work order that we wrote for the asset would close on a continuing basis.
Okay, for point of reference, that's what I thought they were. I guess, depending on who's talking about it, I refer to those as blanket projects. Maybe you guys do that internally too.
That's a synonym, I think.
So, how are these costs determined that the amounts that are reflected in OCC 157, how were those determined for the program ongoing on each of the respective lines?
I mean, we would use a variety of estimating methods, but for the example I used for the pole replacements, we would understand the reject rate that we had seen historically, and then we would have an average unit cost that we would apply and develop a budgetary estimate there. And then as we wrote work orders, there would be some poles that have a lot of equipment on them that would cost more, some poles that have less that would cost less. And we would evaluate, the variances and adjust over periods of time.
These projects are generally reoccurring from one year to the next.
Yes, they would be. Yes.
Do you ever do any kind of historical averaging to see what it's been?
Yes.
Do you generate a document that does that as part of developing these estimates?
We would do that as part of developing the estimates in the first place. So we would we would look back to our, as we're developing an estimate for a project, and there's a variety of different techniques we may use for estimating. One would be a ground up estimate. Another, if you're doing something brand new that you haven't done before, you would find means of developing estimates. We have compatible units that we can use. We have estimating spreadsheets for civil type construction that we use. If it's an ongoing process like customer connections, we'll look at historical averages and then acknowledge or a forecast of what may be changing around us. If we're in COVID, we might temper that estimate in a given year. If we're coming out of COVID and we think there's a rebound, we might expand it a bit. So there's a variety of different estimating techniques we use for these projects. And we look at history and our performance on an ongoing basis.
I guess the one thing I gotta get a little more clarification on is because we were talking about these and they're more, my understanding is these are reoccurring, but you said something about a new project. If it's a new project, it's still could fall under the program ongoing?
I was discussing the estimating techniques when
Okay, so for the program ongoing, we wouldn't have a new project stuck in here. I just want to get an understanding of that.
Good point. I digressed into our different estimating techniques. Apologize.
Not a problem. Could I ask for another late file? I should ask first if it's possible to do this. For the projects that you have listed here, are you able to provide the actual costs incurred from January 1, 2022 to, since we're in February, we'll say January 1, 2023, for these projects, respective projects?
Can you please clarify which projects specifically you're referring to? Those on OCC 157?
Yes, sir.
So you would like the actual capital expenditures for calendar year 2022 or all year to date?
From January 1, 2022 to January 31, 2023, since February is still in motion.
Yes, we can provide that.
Okay. The late file exhibit 33.
Chair Gillette, we're just checking because we did get a late file 17, which would ask for a supplement to OCC 157 attachment 1, describing what portions or what projects we're in service.
On the date of the filing.
On the date of the filing. Yeah, so I think we have a late file that potentially could serve as that, or I'll defer to our witnesses though if that's something different.
The prior late file was a request for the actual plant and service amounts by project from the period of January 1st, 2022 through August 31st, 2022. This request is for actual capital expenditure.
Got it. Okay, so with that clarification, this sounds like an appropriate, an additional late file. Thank you.
All right, thank you. That's late file. This is late file exhibit 33.
I had that as a note. About 17, I wasn't clear. And that'll cover those. That line. My next line was on the UPZ cost that was in your testimony for electric operations and capital program. If you could refer to page 2, lines 1 through 5 of your direct testimony, please. There.
Yes.
Okay. Did you testify on the vegetation maintenance and or the UPZ program in the in 130109 and 160604?
I recall being at the table there, yes.
Were you responsible for the initial estimates for how long it would take and the respective cost for the UPZ program in 130109?
I was not at that time.
You'd agree that was for a period of 8 years, correct?
In 130109, correct?
Yes.
Yes.
I'm sorry, did you say yes?
Yes.
And in 160604, that was extended to 12 years, right?
Correct.
And now you're asking to extend it to 16 years.
An additional 4 years, correct.
The change from going from 8 to 12 to 16, are there any assurances for the commission that you're not going to be coming in another 4 years and asking for another 4-year extension?
So we go back through the history, going into the 13 rate case, we had no experience executing a program like this. We had about 2 years of experience when we went into 160604. I think if you look at the program, we are executing the program, based upon how it was designed in the state of Connecticut with permissioning, traffic control. The duration of the program has caused the growth to extend. So there are a variety of factors that are impacting the cost of executing the program. I think I've demonstrated in our pre-file testimony and in the interrogatory exhibits that we presented here the benefits of the program. So it has cost more than we originally anticipated, but it has provided the benefits that we projected, both in dark sky, in Isaias, in comparison to Sandy, there were 50,000 less customers impacted. And again, if you look at chart CJE1 in my pre-file testimony, you see a steady improving reliability trend for our customers. So it's a complex program. We have had to increase the cost on 2 occasions and are here again asking for that, but it has been very effective. And I will use the storm we had on Christmas Eve as an example of that. I was asked to go down and talk to all 4 news venues about the 50 to 60 mile an hour winds that were approaching us on Christmas, the eve of Christmas Eve. And we had declared a level 5 event. I was asked what we thought the expected impact would be. And we declared that level 5 event because we had seen similar near-term winds with the leaves off the trees and the ground not frozen, and had confidence that our system would respond in a reasonable way. As a result of that storm, many utilities around us had significantly higher impacts than we did. We lost 7,000 customers. We had the majority of them restored midday on Christmas Eve, at a time when the temperature was turning extremely cold. So those are the benefits that this program has generated for UI and UI's customers. It has put us in a position, being halfway through it, that our system performs well in relatively extreme weather. There are limitations to that, but in most of the weather we see, it is having a dramatic impact.
Yeah, thank you. If you could refer, so we're going to go into the next, which basically addresses what you were talking about.
Okay.
You must be reading my notes. Refer to your direct testimony at page 3, lines 20 to 22, and on to page 4, lines 1 through 2.
I'm sorry, could you repeat those, the page and the lines?
Direct testimony, page 3.
Yes.
Lines 20, 22, and then on to page 4, the first 2 lines. Here you indicate there were extraordinary storms in 2011 and 12, and then in 2020, correct?
Correct.
Were there any extraordinary storms between 2012 and 2020?
In my recollection, not what I would declare as extraordinary. I mean,
And after
we lost.
Sorry. Go ahead.
I'll stop there.
Okay. How about after 2020?
We had a couple close calls, but I remember Hurricane Henri coming up the coast, waking up on a Friday, showing a direct impact to the west of New Haven. I believe it was a Category 1, but that didn't materialize and it moved a number of miles to our east. So I wouldn't say there's been anything extraordinary since then.
Okay. Not the Christmas Eve storm?
I mean, that was that impacted some around us pretty significantly, and I think that the fact that it occurred on Christmas Eve makes it much more magnified.
And if I understand your testimony, major storm outages are primarily caused by vegetation management, correct? I mean, vegetation falling on the distribution lines.
Outages and the road clearing that we have to do, yes.
And would you say that your testimony is telling us that's why you need to extend this program for another 4 years?
I think there's a variety of reasons. One, I think to deliver that benefit to all customers. So right now we've done all of the single phase in one pass and removed a little more than half of the vegetation. But the single phase customers we have not gotten to do not share the same benefit the customers we have gotten to share. So I think there's a customer equity element to it as well. If you live on a circuit that hasn't been UPZ'd, you're going to have worse performance than a customer that does.
Are you recommending that these costs be capitalized?
We're recommending treating them as an asset because they are long-lived. They are not, when you create a boundary from the ground to the sky, 8 feet off of our conductors, that is something that will serve customers for a long period of time. And we felt that revisiting, trying to extend the impact of those costs, to minimize the impact to customers would be something to be considered, which is why we proposed it.
Is the capitalization of vegetation costs in accordance with generally accepted accounting principles and or FERC on existing lines?
Like my accounting colleague to
So no, the proposal is not to capitalize them as property, plant, and equipment, but to treat them more so as a expenditure that creates benefits over a longer period of time. I think we could probably assimilate it to the insurance policies we were talking about before, where we're making an investment now, though it does not qualify as property, plant, and equipment under the FERC Uniform System of Accounts, only the first initial clearing when you're making a new line. So yes, agree with that point. But trying to recognize that benefit of the expenditure has multiple years benefit to the company and the customers. So not as property, plant, and equipment, but as a sort of regulatory asset concept.
Okay. If you could, Mr. Eves, you could refer to your direct testimony at page 4, lines 12 to 22.
there.
Isn't your testimony here that UI's day-to-day reliability has been excellent for many years?
It is.
Do you attribute this in part to the extensive vegetation work performed over the years?
I do.
And if you could refer to your testimony at page 47, from lines 15 to page 48, lines 4.
Seven. Line 15.
Yes, sir.
Okay.
If I understand this, you're trying to explain the difference between blue sky clearing and clearance previously done by
Correct.
the company?
Correct.
When was the first blue sky? Oh, wow. Blue sky clearing undertaken by UI?
2013. 2014.
And if you want to continue to look at page 48, lines 11, on to page 49, lines 2. The plan, then, did the plan call for applying the UPZ spec to the single phase portion in one of the system in one pass and to the 3-phase portion of the system in 2 passes?
Yes.
The scope of this program has not changed since then, has it?
No, it was to trim the entire system to that spec through the consent process.
So when you initially set up the program, you had it focused on doing the whole system.
Correct.
Okay. So the only real change we're looking at in the UPZ program between when you initially set it up and what we're looking at today is that you're now looking at it basically taking twice as long and basically twice as much the cost. Would you agree to that?
Yes.
I'm not gonna skip that. On page 49, lines 17 through 20. There you discuss the first pass of the 3-phase, correct? It says will be completed in 2022. Is it completed?
Yes. We've begun the second pass.
And it makes reference to the single phase will be completed by the end of 2022. Is that correct? Half of the single phase. I'm
Half,
sorry.
yeah, half.
And I know this might be splitting hairs, but would you agree that (2022) is 9 years from when this program began? And it took 9 years to do half of it. Should we have an expectation that maybe that 16 is going to go out to 18 now?
Based upon the pace that we have estimated, we would expect completion of the program in 2029. The prior estimate was completion in 2025.
If you could refer to your direct testimony, page 62, lines 1 through 7. 62. Here you're discussing the amortization of the cost, correct?
Correct.
And is it my understanding that you indicate the amortization period is set over a period that better aligns with the benefits?
Yes,
And that period you're saying is 5 years, correct?
correct.
When you're doing a blue sky clearing, do you have an expectation that what you've done is only going to be good for 5 years?
There's so I think there's a combined component of that. One is you're removing full trees. In certain cases, that benefit will last significantly longer. And then you have the encroachment of growth. So I think an argument could be made that that period could be longer than 5 years. We adopted 5 years as our proposal.
Okay, and part of your explanation was there, well, if you take into consideration the trees you removed, that'll last longer than 5 years, but you have the other growth. Is the other growth covered by your normal maintenance that would be done?
That would typically be maintenance, yes.
Are you on a 4-year cycle, 5-year cycle?
We're not on a cycle right now. We're executing UPZ. That is our primary vegetation management program. We would be on a 4-year cycle once we complete it.
So on a circuit that was completed in 2014, are you doing anything on that circuit anymore?
That is why we have proposed the UPZ maintenance program as well, to address those circuits that were trimmed 8 years ago.
Okay. Have you done anything on those circuits between 2014 and now?
We have a maintenance component of our program as well. It's about a little over $1 million that we, Mr. Kleza testified in the last hearing where we're addressing customer issues, direct contacts, things of that nature. But it is minimal, and it is a concern that we have about the duration of the program and the desire to maintain the performance the customers that have been trimmed are seeing, and to not allow a significant amount of work to develop once we get to the end of the program. If we continued for 8 years without doing anything, that first phase of the 4-year cycle would have a significant amount of work to do. So we believe it's in the customer's best interest to address those circuits that have been trimmed 8 years ago now, and have a program that extends until we're completed, going back to those circuits we did 8 years ago to maintain those specifications.
Well, referring to this cycle, I mean, the 2014 circuits that were trimmed, and you said you have $1 million. Has that been sufficient to clear that's been previously trimmed?
It's not sufficient to maintain those clearances. But again, I think if you look at our reliability performance, the trees are growing and they are encroaching. The reliability performance to date has not been impacted. But the concerns you're raising are concerns we have, that if we allow that to continue, that growth to continue, that it will begin to impact customers, especially if it's going to take us 8 years to complete everything.
If you could refer to your your rebuttal testimony. Just want to make sure page 7, lines 5 through 8, please. Do you here identify the areas that have impacted the cost and timeline of the UPC program?
Yes.
Were the impacts identified as issues once the program began in 2014?
They were. I guess our experience with them as the program began is not where it is today. We've had a significant amount of experience executing the program since that time frame.
Did the company during the years 2014 to 2020 limit expenditures for UPZ to be aligned with what was allowed by the authority for those years?
think if you look at our historic spending, as of 2019, we were slightly above what had been allowed. In 2020, we were impacted by a couple factors. We were impacted by the pandemic, the tropical storm Isaias, and a tornado that hit our territory, where we fell behind in UPZ trimming, and we're not able to recover. We were not able to get additional crews into the state to recover the work we had done. 21 got a little better. We were still in the pandemic. And 22, we have come back closer, to what has been allowed in rates, and we expect that before this rate period ends, we will have spent what customers have provided us on UPZ.
So you agree that other than that 1 year where you spent more, you've been underspending on the program?
In 2019, we were even with what we were allowed, and again, as I explained, in 20 and 21, we had impacts that put us behind again, and we're now on a trajectory to get back to where we should be.
The 20 and 21, though, were less than what you were authorized, the spending.
That is correct.
And 2022, you're saying you're trying to catch up. Have you expended as much in 2022 since it's completed?
We expended more in 2022 than we had in those previous years.
Can you tell me how much?
Was it 15.4 million on UPZ.
That's not. What was the authorized? Wasn't it?
It escalated over the initial years and got up to 14 million a year for UPZ. And then another 1.3 million in change for the maintenance program that I described.
So that's 15.3 million then.
But when I said the 15, I was in 22 was only UPZ. Okay. There was additional maintenance on top of that.
When you've identified the level of costs that you've expended from 1 year to the next for this, has the company summarized it so it knows how much was for customer consent, police protection, market constraints, municipal disposal ordinances, and actual vegetation removal by contracts? Do you have that information?
So within our lump sum contracts, we have combined that. So we are not isolating those costs, from the vendors. We can't isolate the police protection.
So essentially, we'd be looking at two lines of information to get your annual cost, the protection and the
lump sum bid.
The lump sum bid. I don't know. Have they asked? Was that asked? Or shall I ask? How we filed for 2018 through 22? Yeah. Last 5 years.
I'm sorry, the 2018 through 22, could you be specific on what you need?
A breakdown of what the actual costs were expended is broken down between police protection and then your contracts.
Okay.
That totals into what you did expend.
Got it.
Okay, and that would be Leaf Exhibit 34, and just to clarify, is the breakdown requested for all vegetation management expenditures, or are we talking UPZ or the maintenance program?
It would be all vegetation management.
Could that be categorized? If it's all vegetation management, could it be broken out by UPZ and maintenance as well?
Well, I believe it can. We will endeavor to do that. And just to be clear, that's non-storm, correct? That you're looking for the program.
Right,
costs.
the program cost, non-storm.
Thank you.
I wanted to clarify something in your rebuttal testimony, page 7, lines 21 to 22. Is it your testimony here that you say the UPZ program does not impose a cost burden on customers?
I'm sorry, what line did you reference, sir?
Page 7, lines 21 to 22.
So I think, and actually referring back to the REOA docket and kind of the considerations listed there, there is a cost to UPZ, but the benefits to customers are significant. So I think I think the program has significant merit, and the benefits outweigh the cost. I think that the reaction to Superstorm Sandy, Isaias, that the resiliency benefits that it provides now and will provide when it's complete, as well as the day-to-day reliability benefits that our customers see. The impact of outages to our customers is significant. The impact to our municipalities and the safety issues associated with these trees coming down on the roadway. When we're road clearing, we're not clearing rain, we're not clearing snow, we're clearing trees that have fallen into the roadway with enough force to have taken down our facilities. So there's a public safety implication to the work that we do here. There is in doing that as well, we've come to recognize with the municipalities their need to get to the residents in these extreme weather events. And we have created processes that devote significant resources at the beginning of a storm to clearing these trees. Those are resources that are not turning the lights on. So this program is proactively dealing with thousands of those trees, thousands of those points of risk, thousands of those points of delays every year to improve the experience of customers in extreme weather. So I think the benefits that this is providing far outweigh the cost in the long term.
In reading your testimony there, I'm trying to get an understanding though of your understanding. And you make reference to the OCC testimony and saying that it implies that the proposed schedule for UPZ program imposes inefficiencies and cost burden on the customers, and then you say this is false. Is it your understanding that the OCC is saying that the UPZ program, which is doing a blue sky work, is inefficient and not providing any benefits to customers?
I'm not trying to imply that. I'm trying to imply that it is only a cost burden to customers, and that concept is false. I see it as a benefit to customers.
Thank you. We're going to skip a couple questions here. And we already talked about that, so I think we can skip those. We're getting near the end of mine, so that should be a positive note for you. I got to get into this line of questioning here, or your testimony. First of all, I want to understand something. Mr. Eves, could you refer to your direct testimony at page 2, lines 1 through 5? Oh, no, I already asked you that. Sorry. Page 1, lines 13 through 21.
I'm sorry, this is back to the direct testimony now?
Direct testimony, yes, sir.
Sorry, Mr. Schultz, the page in that line you said?
Page 1, lines 13 to 21. Your educational experience.
Oh, okay.
It says you're an electrical engineer and a professional engineer.
Yes, sir.
You got any other titles? Any other degrees?
I've listed them. I've listed my degrees there.
As an electrical engineer, when it comes to the removal of vegetation along the rights of the way, what is your responsibility?
The execution of that program resides in my organization.
In your organization?
Correct, in electric operations.
You're not a certified arborist, are you?
I am not, no.
Have you personally performed any line clearing work?
I was a grunt on a tree crew in college, but not for a utility. But yes, I have moved a lot of brush into a chipper in my life.
Oh, we won't get to the grunt part. I know what that can be. So I've seen those. Have you personally removed any trees after a storm that have fallen along the right of way since you've been employed?
I've been on scene for many. I've not actually done it myself, no.
Have you personally removed trees from live wires?
I have not. No, I'm not a qualified high voltage lineman.
I'd like you to refer to your rebuttal testimony at page 9, lines 12 through 14.
Yes.
Is it your testimony here that the OCC witnesses are not qualified to opine on the company's line clearing and costs because of their lack of experience?
This reference was to the contention that vegetation management workers to execute this program were readily available, which is something that we understand, through experience is not the case.
I guess I'm not following your response. Are you saying that the OCC's witnesses aren't qualified to address the tree trimming and the vegetation management activities that are being done because they're basically just an accountant?
This is, again, back to the reference about the availability of the contractor workforce and the evidence provided on the contractor dynamics. So we have direct experience with the contractor market, trying to acquire crews capable of doing this work effectively and safely. Working on 80-foot trees above an active public right-of-way with energized electric conductors directly below you. Those resources are skilled. They require different equipment than a typical line clearance contractor would, and are much more difficult to come by than a general line clearance contractor that can trim the typical maintenance specification that you may find at other utilities that's 15 feet above, 10 feet to the side of the conductors. That work is much more challenging to do it effectively and safely. And the market is much more challenged to get those resources in place.
I follow your explanation, but I'm not seeing that I'm getting an answer to the question. Are you saying that the OCC witnesses can't address the line clearing and the costs associated with that appropriately? Because as you note on lines 16 through 18, they're looking at it from only an accounting perspective and not an operational experience.
Again, I'm taking umbrage with the comments made on pages 61 and 62 of your testimony that these contractors are readily available. And the assertion that they are contradicts our direct experience here.
So when you're saying that you're taking issue with the OCC's testimony that says contractors are readily available, is it your understanding that the OCC wouldn't know about availability of tree trimming contractors?
Of tree trimming contractors capable of executing our UPZ program the way it is derived here in Connecticut safely and effectively.
Are you aware of any background the OCC witnesses may have in dealing with vegetation management costs and contractors over the years and in the years that they've worked in rate cases?
I am not.
The issue here is the work that's being performed, and not only that, but the costs associated with that. Is that correct?
The pace of the work also depends on the availability of qualified, skilled people to do it safely and effectively. So yes, I would say those three elements are significant factors in this program.
If it comes to determination, what's a reasonable cost? And again, when I address what you stated in your testimony there in lines 16 through 18, would I be incorrect to assume that unless the authority, the PURA, actually had experience in vegetation management work, that they wouldn't be able to make a determination on what's a reasonable level of cost and the work to be performed?
I don't think I follow that assertion. We're leveraging the market through our lump sum bidding process to try to get the most effective cost for our customers for this work. Again, that the statements you're referring to were based upon the assertion that there was, I'll paraphrase, but the ubiquitous availability of these contractors, and to our experience, there has not been.
That reminds me of something else that was talked about on this UPZ cost and stuff. When somebody, I forgot who it was, from Pura that was asking you the questions, and the explanation was given that you have the some contractors and you have some time and material. And what I was wondering is, there was a discussion about what happens when the circuit isn't completed that was supposed to be completed by the lump sum contractor. And if that didn't occur like it was supposed to, what happens? And the response was that you'd get another contractor to finish that work. Is that correct?
That was a new contractor that we brought in.
So that is an example of a contractor that we brought in that had experience trimming the typical maintenance trimming that you've described. they did not, in their bid process, fully understand the implications of the permissioning process we have here in Connecticut, nor did they understand the impact that the traffic control would have on their ability to set up as a kind of assembly line and process through the work quickly. So they did not build into their contract the time that they needed to get that work done.
But when you,
So they
sorry,
they defaulted on that, and we moved the work to a contractor that had won other bids as part of that process.
was this just a one-time event?
That's the one event that we've had where we brought in an additional contractor. And that was our experience with them not understanding what it takes to execute the work in the program we've defined here in Connecticut with the tree conditions we have in Connecticut, and the permissioning conditions and the police protection ordinances that we have.
How many contractors do you have that you utilize?
So we have 4 of them working, and then how many do we bid to? Like 20? Yeah. Yeah, at least 20, 25.
So we bid to 20 or 25 contractors, and we have 4 currently working for us.
Are they all local contractors?
No, they're not all local.
Are there any that are Connecticut-only contractors?
Connecticut only.
Yes. Which one?
Investments only Connecticut. No, they work everywhere.
When you say Connecticut only, are you talking about the employees that work for them, or the contractor themselves?
I'm talking about a contractor that might be, and I'll give you some examples. Asplin, Davies, that they're different contractors that do line clearing. So they're all around. How is that?
Yes. So we have those types of contractors at UI.
When you sent out the 20 that you were talking about, were those national contractors, or were they, or most of them local contractors?
We're in a bid process. We're trying to get a wide swath. I mean, we're trying to be inclusive in that bid process, and then through the vetting process, and our procurement process. Get qualified contractors to do the work. So, at the beginning, we try to be inclusive and open.
But at
a reasonable level.
Yeah, I'm trying to get at. You said something made mention of 20 being sent. Requested bids. So are we looking at
engaging in the initial process?
Was maybe one a Connecticut-based, 2 Connecticut-based? I'm trying to get a handle on this.
At least one. At least one.
So I can assume then from that response that 19 of them are national companies,
or do work in multiple states as a veg management contract, and are qualified to work around high voltage lines. Not just the tree company that I work for in college, but qualified for line clearance in the utility sector.
I understand. In your rebuttal testimony at page 10, lines 10 through 16.
I'm sorry, you said back to rebuttal?
Yes, sir.
Lines 10 through 16, page
10, lines 10 through 16.
Okay.
And is it your position here that absent the $3.5 million of maintenance funding, it would be difficult to maintain portions of the system that have already been conformed to the UPZ specs?
Well, they would, they would, over the period of time that would elapse, if we were, granted the ability to finish the UPZ and we did not go back and maintain the circuits that we had trimmed 8 years ago, by the end of 16 years, they would not conform with the UPC spec now. They would not have clearance ground to sky 8 feet off of our conductors. And the work, by not doing it, it's not a direct savings. It's work that's accumulating. It's a bow wave that's developing in front of you that has to be dealt with at some point. So again, we think it's in the customer's best interest to go back in now, maintain the benefit we've created, and then create a reasonable amount of work when we come out the other side, having completed the program.
Was there a maintenance amount included in the last filing in 160604 for this general maintenance?
That 1.3 million I referred to. I think that my recollection is that escalated over the rate years. And that's there's a number of things that go into that customer requests. So that's not just maintaining the UPZ spec. That's a number of different elements, including customer requests for trimming direct contacts.
Okay, I've got maybe one more question. In looking at the calculation of the costs that you factored into this rate filing, you calculated what the amortization was of the annual expense, and then you added $3.5 million for maintenance. You recollect that calculation?
That is what's reflected in the revenue requirement.
If that's what's reflected in the revenue requirement, and you're already getting 1.3 that was previously in there, are you saying that the 3.5 is in addition to the 1.3, or is it?
Yes, we would be. So the scope of the 3.5 would be to go back to the circuits we have already trimmed and regain the UPC spec. The 1.3 would be dealing with the. Could you list what those elements were?
And that 1.3 was reduced to 850K. And that is to address, like what Mr. Eves said, customer request, any direct contact, hotspot type work, more imminent threat, less circuit level maintenance.
Okay, I'm trying to visualize that calculation. I don't have right in front of me, but I thought it came down to, this is what the amortization is. This is our $3.5 million. This is what we've been recouping. And so you made an adjustment based on that. I guess if that number that you said was recouping, was that when you determined what was in the amount being added to rate year one? Or actually, in your case, it was a subtraction, that you, the amount that you're reflecting as in rates, was that in rates amount only the UPZ cost, or was it the UPZ cost plus the 1.3? You understand what I'm saying?
I lost you there.
Okay. In your filing, you reflect an adjustment that basically reduced the vegetation cost in rate year one, correct?
Yes.
When you did that, you calculated by saying, this is the amortization we're reflecting, this is the 3.5 million. And then you says we have this total for expense. And then you said, this is what we are currently recouping, recovering from ratepayers. And so we're reducing vegetation management costs by this net result.
Okay.
I'm asking, is that number that is what you said is what we're recovering currently a UPZ number only, or is it the UPZ plus the 1.3?
Is there a schedule you could point us to? We're struggling to follow the backing out of the 1.3. And to clarify, we're not seeking to recover past costs. It's just going forward.
No,
So
I
maybe if you could point us to a schedule, that would help.
Unfortunately, no. This question was prompted by his responses there.
We believe it's 3.05C, where that would be reflected.
Yeah, and there's no adding the 1.3 from the past rate case. There are 4 categories there.
No.
We're getting a little bit twisted around by your question. I'm sorry. We want to provide what you're seeking.
What schedule was that? Yeah, you were referring to?
I believe it's C schedule 3.05.
3.05. Get that up. No, what I was trying to explain to you though is when you calculate an adjustment in a rate case, you say, this is what we're projecting the cost to be. This is what is currently the expense. And then the difference is what your adjustment is. And the number that you're saying is this is what the expense is. I'm asking, is that inclusive of the 1.3 or is that the UPZ cost only?
Okay, so maybe where we were getting turned around is our revenue requirement begins with a historical test year, not what was established in 2016.
Right.
So our adjustments are relative to the historical test year.
Right.
Right.
And Mr. Eves indicated that the 1.3 was in the historical. So that's where the question is in the historical question year. Is that number that you have on that schedule UPZ only, or is it UPZ plus the 1.3? That's what I'm trying to get at. Final answer, John.
So there's a line for the utility protection zone, which has a historical test year amount and then reflects our proposal to defer and amortize over a 5-year period. There's a line for utility protection zone maintenance, which is the 3.5 million we've been discussing. There's a line for processes and technology, and there's a line for electric operations.
All right. That's all. For me.
All right.
I have a couple of questions about polls. And then we'll turn it over to Attorney Minkowski for some more questions. There was some testimony this morning regarding the make ready costs associated with pole attachments. And if you look at OCC 459 attachment 1, there's a line item in there for third-party pole attachments. It's called the replacements, described as the UI make ready cap. It's like a $50 million line item over 5 years. I was just curious if you know what's included in that budget.
So the make ready cap includes the cost of replacing poles that were found to not to comply with NESC criteria. As we do our pole attachment surveys, and we find that condition existing before we apply the existing or the I guess the instant attachment.
Okay.
So those are to bring poles in our service territory up to compliance with the NESC. given the forces and loading on them.
Got it. Is any element of that budget recovered from the pole attachers?
Costs that we can directly attribute to the incoming attacher would be, these are poles who have a pre-existing condition that puts them out of compliance with the NESC.
So what does that mean to a person like me who does not know anything about poles? Does that mean the pole's damaged?
It means that under the forces that the NESC considers, given ice loading, wind loading, that those poles could fail in serious conditions. So for our area, there are certain standards of loading that the poles have to be able to adhere to, and the attachments that have been placed on them over the years put them in a position where if they were exposed to those severe conditions, they might not have the structural integrity to survive.
So ultimately, it sounds like the causation for them being out of spec is attributable to pole attachers, but you can't always know which pole attacher is the cost causer. Is that accurate?
And I mean, our facilities are a factor as well, right? So if we have heavy objects on the poles, it's our facilities, it's the ILEX facilities, the incumbent communication company, Frontier, and then the facilities of the attachers all combined, creating those loading conditions.
Okay. So you mentioned that if to the extent you can attribute that condition to an attacher, you can allocate some cost to the attacher. What does that process look like? How do you determine how to allocate that? I mean, not how to allocate it. How do you determine the causal factor, if you can?
Well, that would be a case where our calculations demonstrate that the pole is in compliance before we put the attacher's conductor up on the pole, and then once they went up on it, it was no longer in compliance. So then they would be the causer and would be billed for that make-ready work.
Okay. And is there an analysis prior to every attachment of whether the pole is in compliance?
There is, yes.
Okay. So it seems like then that under every circumstance, you'd be able to conduct that analysis and get a clear yes or no answer as to whether the pole attacher's attachment is the cause.
And we are for the new attachments.
Okay. Can you explain how the company processes a pole attachment application? Like first the application's received and reviewed, and I think subject to I don't know if you heard the brief cross-examination yesterday. I had a discussion with the NECDA witness about administrative costs. Did you hear that? So my assumption is that those sorts of costs we were discussing yesterday cover the company's costs incurred in reviewing those applications when they're received. Is that accurate?
So there's a couple elements to what we do with regard to pole attachments. We are the single pole administrator. So we have administrative responsibilities to maintain the database of poles and the attachment activity that's going on. And then in addition, we're also executing the make-ready work we have on the poles that we're custodian. And in those cases, the attachers are providing attachment fee or application fees that cover some of the cost of executing that, as well as we record attachment rates as well that we discussed at length over the last couple of days.
Right.
So those are the revenue streams, and we have engineering resources. We leverage our day-to-day engineering resources that really are sized for the past when we had very limited amounts of these coming in, and then we've leveraged contractors to execute that design work. There's a high level of volatility. We get many applications in a big batch, and then at this point we're in the process of running out of work for those engineering staff to execute. And there's talk of a new batch coming relatively shortly. So it's volatile, and it can swing pretty significantly in short periods of time.
Okay. A couple questions. You mentioned the fees that can cover a portion, I think, or some of the cost, I think was the word you used. So those are we're talking about the engineering costs. Well, that's, my focus is on the engineering costs. Because after you've processed the application, you have to do the engineering, which to my unengineer understanding is someone's got to figure out, is it safe to put, like, can we put this physical load on this pole? How is this going to work? You have to draw up a plan, right? That's the work we're talking about. So that work is work done by UI, and and the fee covers some of that, but not all of it. Is that what you're saying?
So there is a per pole survey fee that covers, that direct work that is executed. But, all the work associated with the entire universe of managing the pole attachments across the company, I think there may be some shortfalls in recovering everything. But there are elements of that process that are designed to recover the cost of each independent element. And that per pole survey fee, which would be the beginning of the process, would be one of those.
Okay. And you mentioned a second ago the volatility of the work, that it ebbs and flows. Sounds like sometimes there's too much to do, and sometimes you're running out of work to assign to those resources to. It sounds like that it make sense to continue using contractors then?
So the challenge with contractors with volatile workloads is that we bring them in. There's a tremendous learning curve to bridge them on. This is niche work. It's not something that's done in industry. There's not a large number of people on the bench that understand how to write distribution construction work orders in SAP, that understand distribution pole line construction. So in general, we're seeking people with aptitude. Then we're pulling people out of our production line to get them up to speed. And then, dealing with all the administrative elements of background checks and IT access, and we get them up to speed. They work through the bundle of work that they have, and then when we run out of work, we typically lose them.
Yeah.
Places and may or may not be able to get them back. It's possible that our need would coincide with a shortfall in someone else's need, and we could get the same individuals back that we train internally, but that generally is not the case.
Yeah, it sounds like pretty common issues with, like, that's always the downside in hiring temps or contractors in general, right? But isn't the downside of filling that role with full-time employees that you're going to have a circumstance like it sounds like you're running into now, where you have people sitting around with nothing to do who are being paid with ratepayer dollars?
And I think that's the balance we need to try to find is we want to be responsive, to the needs to connect broadband. We want to make sure that we have a sufficient level of trained resources to meet the timeline expectations, ready to go, given the volatility that we have seen and continue to see with this work.
Are you aware of any other jurisdictions where the pole attachers have to provide their own engineering work as part of the application process?
So that is an option that has been developed into Connecticut's process. To date, there's been very little adoption of that ability. And I guess let me clarify, very little as no adoption to date.
But an option, does that mean that the attachers can voluntarily provide their own engineering and thus not have to pay that fee? Is that what the option is?
And or define their own timelines, I guess, as well, so that there'd be a fee element and a speed element associated with that.
Okay.
With their choosing to staff up and do the work themselves.
Okay. Is it your understanding that in other jurisdictions that is framed only as an option, or are there jurisdictions where the standard is that the attacher is expected to provide their own engineering?
we've seen in New York an adoption of it. That's the one jurisdiction that I'm familiar with.
Okay. That's all I have on this topic. I'm going to pass the mic to Attorney Minikowski, and then I have a whole set of random cross to conduct afterwards. Thank you very much.
The implication there is that this cross isn't random, but I'm sorry to inform you that it also is. I'm going to pick up right where Attorney Wheel left off on some of these issues around pole attachments and the resources that are required to be devoted to processing those applications that ebb and flow in volume. If the company were to hire additional full-time personnel that would focus on processing those applications during periods of time where the volume of applications fell off, are there other functions employees with that training could perform for the organization?
I think there are certain inspection activities that they could potentially do. There's mutual assistance work that they could do for, with damage assessment that could offset some of those costs. And I think we've requested 25 in this instant docket. I think we would look at the scale of work, and that 25 is really driven by conversations we had with the attachers leading up to our filing of this.
Okay.
They indicated about 25,000 attachments in the next 2 years. So we drew a line. We said, we would probably need about 40 FTEs to execute this. Let's bring in less than that internally. This is going to be something that continues for a period of time, and then we will scale the remainder with contractors. So I think we would assess on an ongoing basis the activity in the market. We would continue to leverage contractors, but have enough resources dedicated to this so that when these attachments came in, they weren't competing with customer work, project work, storm work. These resources are focused on delivering the timelines and this work for the broadband needs as a priority.
Okay, thank you. So if the poll attachers are correct in their prophesying and there are 25,000 applications over the next 20 or 2 years, and the company did, let's just say hypothetically, get 25 new full-time employees to help process that, the overall volume of work, would that be majority performed by employees or contractors at that point? Could you just give us a general sense?
It'd be the ratio of 25 to 40. So that, what is that? So 25 of the 40 FTEs would be internal in that scenario, and the remainder.
Okay, and the rest
external.
would just be contractors.
Attorney Minikowski, do you mind if I interrupt you for just a quick second?
Absolutely.
When you say 25 applications over the next 2 years, that's just for UI territory?
25,000.
25,000 for
Okay.
just UI territory.
Let me clarify, though, that those were conversations that we had prior to the rate case. Those have not materialized in 23 to date. So that market is changing, and we've actually got word that we may be getting 10,000 from one of the vendors that said that they weren't going to be doing any work. So
now it's 25 to 35.
Those 25 haven't
Conceivably.
materialized yet, but
Conceivably.
they could show up tomorrow. Yes,
But again, is it just UI territory or is that
Just UI.
statewide?
just UI.
And so obviously you're competing with contractors that would be also, and I guess you'd extrapolate this at a magnitude of whatever Eversource number is.
So after we got over our peak, because we had a peak of work we were plowing through, we had 30 contractors in place working on that. We've come down the other side of that now, and I think in general most of them have migrated there.
Sure. Thank you very much.
Thank you, Commissioner Karen, because you asked one of my questions. Has UI explored any sort of resource sharing with the other Avangrid affiliates in regard to employees for this issue? Is that some sort of arrangement like that possible?
It's in the realm of possibility with some challenges, and geography is one of them. It's a big service territory, and people have lives and families. Okay, it is something that could be looked at, though.
Okay, thank you. I appreciate that. To follow up on Commissioner Karen's question about competing with Eversource, has the company for contractor work on this issue, has the company considered any sort of joint approach with Eversource for tackling the volume of these applications and ensuring access to contractors?
I can't say we've done that. It's an intriguing idea, potentially, but we have not done that to date.
Okay, thank you. But that's something the company would at least take under consideration.
Consider.
Thank you. All right, I'm going to refer to interrogatory OCC 522. And I think that should appear on the screen. And once again, not to belabor this, but it has to deal with the annual costs of processing poll attachments, as well as the revenues that come from application fees and other associated fees. And my general question here is, there's a statement there. There's no line numbers, so, but you'll find it when I can read it out loud. Quote, during the next, oh no, sorry. That is wrong. I retract everything I just said.
You said 522?
Yeah.
Okay.
Is that the one on the screen? I can't see it from here.
Yeah.
Okay, thank you. So in terms of the recovery of costs, related to poll attachments, what is UI proposed for recovery of such costs in this proceeding? You can just give me a general explanation.
Okay. So I guess embedded into our company, we have the administrative responsibility of being the single poll administrator. And then we are, as these applications come in, we are recovering the application fees, the surveying fees. And then we are, incurring the cost of executing that work. In general, we're using a mixture of internal resources and contractors as these applications show up, and we're scaling those contractors up and down to date, based upon that. The challenge we will have is if we run out of work and then get a steep volume, we will have to go out, bring in additional contractors, train them, incur those costs. So in general, that's, we have our cost structure as a utility that's being presented in this case. We have the volumetric revenues that we're getting as these third-party attachers apply, and there's some level of balance between the two.
Does the company maintain a record of outstanding invoices to poll attachers?
For the attachment fees being on, yeah. Yes, and we bill them regularly.
Okay. Has that information been filed anywhere in the record of this case?
Okay.
I couldn't find it, so thanks.
Your question is with regard to attachments? To the paying the attachment fee that we've discussed over the last couple of days?
Yeah, a record of those attachers that haven't paid that fee and those invoices are outstanding.
It's not this.
Yes, we have those records. I don't believe that has been filed in the case to date. The outstanding attachment billing, I don't believe that's been filed.
Is that up to date, or what? How current is that list?
We have a current list of the attachers and the billing history.
Okay, I I'm not, well, how voluminous is that list? I have,
I mean, you're looking for the current balances for each attacher?
yeah.
I mean, it would be 20 or 30, right?
Is that something that could be provided and it wouldn't be unduly burdensome?
Not unduly burdensome.
All right. I'd like to request my first late file of DUI rate case hearing. So this would be a list of the outstanding unpaid invoices to pole attachers.
From pole attachers.
From pole attachers,
Right.
sorry.
Okay.
Yeah. And I think that's 35, if I've been counting.
That's correct. So if Attorney Minikowski will accept a friendly amendment, I think, so provide the current outstanding balances by pole attacher, and the friendly amendment would be if you can show the length of time that the balances have been outstanding. Like, how does the company, like, if you can clarify how the company might define if it's overdue or how long it's been outstanding.
Okay.
Thank you.
Okay. Some additional data that everyone is current at this point.
Okay,
with their
perfect.
attachments.
Thank you.
Oh, okay, so late file exhibit 35 is not warranted.
I guess, if that's the case, is it warranted? Attorney
So no
Minikowski?
one has an outstanding balance. Everyone's,
Not as of right now.
okay, all right. So we don't need late file number 35. If someone were outstanding or had an unpaid invoice, what's the company's policy in regard to that?
So we have a standard invoice time, and then we would hound them. Essentially, we would contact them repeatedly, and generally that is worked for us to date.
Okay.
With that issue.
Thank you. I'm going to return, we're going to move off the polls, and believe me, I'm glad we're doing that as well. Interrogatory response RSR 12. I'd like to direct the panel's attention to that interrogatory response. So the analyses referred to in this interrogatory response, they were expected to be completed by February 2023. Were those analyses completed by the estimated date?
Okay, so this was the analysis for the distribution automation in terms of the ROE, yes, and we have that, we've just completed that.
Okay. It hasn't been filed yet? It's just.
No, actually, would you request a late file for us to file that? Or the appropriate mechanism?
Well, perhaps Attorney Minikowski will do that.
I believe I would like a late file, perhaps number 35, of the analyses that were requested in RSR 12.
And in that, we applied the RE08 framework to the automation program on the 80 circuits that exceed the pure threshold of 0.64 SAFE.
Great.
And have generally determined that, that those programs have a positive business case, generally.
Great. We'll look forward to reviewing that.
Okay.
My next question will relate to interrogatory response RSR 59. And this is a similar question. In this response, I'll wait for it to go up on the screen unless you have it before you. There we go. The company in its response here mention that these analyses are ongoing because they're, again, working with a third-party contractor, and they were expected to be completed by February 2023. Have they been completed, and if so, have they been filed?
I'm sorry, this refers back to RSR 12.
Okay, so it's the same. There wouldn't be any difference between what you would be providing there and here.
Yeah, I
Okay.
think I think this was kind of it's asking for the same thing.
Yeah, I just wanted to make sure there wasn't
Okay.
any difference.
Sorry for jumping in. I believe RSR 12 references a historical analysis, and this is referencing projections. So just confirming that what's been completed has both of those.
So the analysis that will be filed includes the projections of the performance
Okay.
with that program.
Thank you. Perfect. So over my next series of questions, I'm going to be referring a lot to this final decision in docket 17-1203 RE08. So it might be helpful if folks have the ability to pull that up or have that available, because we'll also be referring to it in connection with other responses and evidence currently in the record in this proceeding. So I'd first like to direct everyone's attention to page 44 of the final decision in the RE08 proceeding. And the highlighted text on the screen, if folks could just take a moment to review that and refresh your recollection with it.
Trying to see building, starting with building. Okay, building.
Yep. And once you've reviewed that, my question is, does UI agree that the company must propose a plan that considers the company's reliability needs and also conducts an analysis that targets an average 5% reduction in the SAIDI and SAFE values, blue sky conditions, during the rate plan, calculated from the 4-year average derived from the previous reliability framework cycle?
Could you just give me the preamble to that question? I have the content, but what are you asking?
So does UI agree the company must propose a plan that considers the company's reliability needs and also conducts an analysis that targets an average 5% reduction in the SAIDI and SAFE values, blue sky conditions, during the rate plan, calculated from the 4-year average derived from the previous reliability framework cycle?
Yes, we understand that to be the directive here in this decision.
Thank you. And now I'm going to refer as well to table CJE1 on page 6 of your pre-filed testimony, Mr. Eve.
Mm-hmm.
We'll just get there so everyone can look at it. And can the company confirm which of the categories reflected in this table are included in the proposed reliability plan that we just talked about in the previous question?
So in the global statement you just read about ensuring that we have that our reliability performance is conforming with that improving standard. It really is the combination of all of the things that we are doing lead to that. And we've discussed UPZ today. We've discussed over the course of this proceeding infrastructure replacement. Those are elements that are contributing to the ongoing improving performance for UI. So they're elements and they're baseline elements in our plan. In this proposal for the rate plan, we have also considered some incremental activities. One being 9 projects that we've evaluated for resiliency around the standards laid out in this decision. And we looked at expensive high impact solutions and less expensive, lower impact solutions and did business case analyses on them. And we've proposed the beginning of that. We've not proposed the entire CapEx stream necessary to execute all of it, but the beginning of it. We've also included the reliability automation program that we've described that would address the 80 circuits on our system that are performing worse than the PURA prescribed target of 0.64 SAFE. So the combination of all of those things, we believe, would result in a trajectory that would meet or exceed this criteria that you just described.
Okay, thank you, Mr. Reeves. Has UI conducted an analysis to determine the average SAIDI and SAFE reductions expected from implementing each proposed reliability program?
The incremental reliability programs that I just described, the resilience and the automation we have.
Okay. Is that analysis in the record in this proceeding?
It will be once we file your late file.
The late file will conclude it?
Yes.
Perfect. All right. Great. That makes things easier. I'm going to direct the panel's attention now to the interrogatory response to RSR 89. And it's up on the screen. And in this response, UI states, quote, the company, SAFE and SAIDI performance in 2022 were both better than the 5% improvement thresholds based on the 4-year average from 2018 to 2021, end quote. And the company also states, quote, the company believes that the investments in this case in aging infrastructure, vegetation management, and automation will allow the company to maintain the improving reliability trend in the near term, end quote. Is that generally correct?
Yes.
What were the 2022 results compared to the 5% improvement thresholds?
So our result in 2022 was a 0.44 SAFE.
Thank you. In numerical terms, what is the improving reliability trend the company believes will be maintained?
So chart CJE1 in my pre-file testimony shows the long-term trend of our SAFE performance, which is the frequency of outages that the customers experience. So I think if you look at that, I mean, visually you can see a long-term trend of improving performance. There, at some point, there will be an asymptote, but I think with the UPZ work we're doing, if there's adoption of these programs that I think, given the RE08 framework and what we presented, I think they bear consideration from a cost benefit analysis perspective, could have significant improvement to that trend as well.
Thank you. In achieving those reliability trends, is it the company's opinion that requires all of the proposed reliability programs or only some subset of those that have currently been proposed?
I think the baseline of investment that we have been executing outside of the automation and the resiliency programs would provide an improving trend. I think those programs would be incremental, and I think they are a decision, for customers. I think when you look at the business cases make sense. If you're looking at societal cost, right? So they're based upon societal cost. They're based upon a little bit higher electric bill, but a lower cost in my pocketbook overall for certain customers. I think that was the kind of the brilliance of the ROE docket to begin with. It's a view in that context. Is there a business case at a societal level to do more with resiliency and reliability? And I think I think we've shown that for certain projects and certain circumstances, there are.
Thank you, Mr. Eves. You predicted and answered my next question. How does the company propose that the forecasted improving reliability trends be measured and validated if they aren't specifically quantified or correlated to a specific proposed program?
Well, I think there are definitions in how reliability will be measured and quantified, and they've been expanded to CLID and CME, to look at specific customer impact. I mean, the individual contributions of each of the programs on their own is a bit difficult to measure. And, I believe it's the combined result that you get. I think you can project, and you'll see those projections in the analysis we give you. You can project what you expect the improvement to be, and then the truth comes out in that long-term trend that is in my CJE1 chart. So I think, monitoring that over a period of time, testing some of these projects out, doing some assessment on the conditions that the system saw during those periods of time. Was it 2020 or was it 2022? Right, a relatively mild year versus a very stormy year, and then making those judgments as we move forward.
So there are a variety of factors, you would say that's fair, that would inform that determination. All right, thank you. I'm going to direct the panel's attention back to the RE08 decision. I know this should appear on the screen forthwith. Page 51, footnote 25. And therein, the EDCs are directed to design and submit a plan to remediate as many tier 1 to tier 3 priorities as could be accomplished up to a threshold projected to achieve an average 10% reduction in SAIDI and SAFE. I don't have a question on that yet because I'm also going to refer to page 52 of the decision regarding the worst performing circuit program, which Ms. Reeves, you've already alluded to today. And this is regarding the authority's requirement that the EDCs develop a reliability corrective action plan based on those 4% of the worst performing circuits. So just like generally, how has UI complied with the directive to identify the tier 1 through tier 3 priorities and to design and submit that plan that's required there? Has that occurred yet?
At the end of every March, we file a report we call the TDRP, and we are actively working on the new reliability measures, and have actually looked at the system in that way, and we'll be finalizing that in our action plan with that report.
Thank you. The budget associated with that, where has that been included?
It would be in corrective reliability.
In OCC 462, attachment 1, the UI includes 1.8 million between 2023 and 2027 for reliability improvement TDRP. Is that what you were referring to, Mr. Reeves, just a moment ago?
Yes.
Okay.
Now there is a bit of a discontinuity. We established that budget in advance of fully doing the exercise. So we're currently evaluating what those projects will be. So there's there may be a disconnect there, but that is something that through our process we will manage.
So do you anticipate revising that number at any point in this proceeding?
I don't believe it will create a material variance to require us to do that at this point.
Okay, thank you. When does UI cease when does UI anticipate ceasing the corrective action plans to address the 4% worst performing circuits as part of the TDRP report?
So this year we'll be focusing on the CME C-lid circuits tier 1. So we've identified a series of customers that have experienced multiple outages. They're small pockets of customers, but we did, through that analysis, determine that there are some that have seen, at the end of certain fuses that have seen significant numbers of outages that we will develop plans to address. And then C-lid, which is the duration of outages, extended outages, we will have plans to address those as well, tier 1 circuits.
Thank you. Does UI plan to perform work under the proposed distribution automation project to address feeder reliability?
That proposal is to address the 80 circuits whose safety performance is below the 0.64 target.
Okay.
As worse than, I guess. Above.
All right, thank you. And we're gonna stick with the resiliency theme for a little while longer. And I have questions about 4 categories: step down bank removal, coastal substations, substation getaways, and other system resiliency. The step down bank removal, which is proposed at 16.4 million. Did the company perform a benefit cost analysis in relation to this?
We did not. That is an existing resiliency program. It's a combination resiliency program and aging infrastructure program that addresses the aging infrastructure that was left in place as we were doing our 4 kV substation conversion. So when I started in the company, we had 100 of them. We have 1 left now. But as we were doing those projects of converting from 4 kV distribution to 15 kV distribution, if the assets had substantial remaining life downstream of a certain point, we left them in place to utilize and reduce the cost of those projects. So those step down banks went up and create a pocket of 4 kV that you can't back up from the surrounding area typically. As time has progressed, the assets in those areas have either been replaced or require replacement to bring them up to 15 kV standards. And those projects allow us to replace that aging infrastructure and then eliminate that pocket of 4 kV. So those customers have a better chance of being backed up in extreme weather.
Okay, thank you.
Attorney Minikowski, I think we need to take a break if you don't mind me interrupting.
I do not mind.
Okay, so we're just going to take a 5-minute break. So I'll see everybody back in 5 minutes, please.
Oh dear, I was trying to guess. Well, I still have a couple more pages, but a lot of these are quotes, so it doesn't take long to see. But what I surmise is we can
There's one thing that on my
I think we're in a general walk that I thought we were gonna be Bill had a lot of crossing over what happened this morning. I actually have 1 hour. Oh, okay. We're not doing any time tonight. No, that's kind of interesting. Yeah, you probably still have.
Or at least if you switch chairs, sit in that chair.
Where, no, it's yours. I think it might be. Because I didn't bring it or just, yeah.
Camera one, camera one. I mean, my turn. Yeah, no,
I think so, but you would know best.
yes. CLID.
Not yet.
Okay, I think we're about ready to resume. Go ahead.
Thank you, Chairman. I hope everyone had a reinvigorating break. So we left off talking about, I'd asked whether you had performed a benefit cost analysis. Mr. Eaves, you had answered that question. Does the company have any sense of the safety and safety improvements associated with step down?
I think that's, it's dependent on the mainline connectivity of each individual step down bank. That program, I think has minor impact on reliability, but the aging infrastructure issue is kind of a necessity issue. And when you're done, once you have transitioned most of that infrastructure away from the 4 kV standard to the newer 15 kV standard, it's beneficial to bring the customers up to the new standard. So that one I think is it's more of an obsolescence program than something that's really going to drive reliability and resilience, with the exception of that backup capability.
Okay.
Right. So if it's a major event and you've now provided an alternative means to back those customers up from a problem, that's a significant performance asset.
Thank you. I'm going to skip that one. So I'm going to turn the conversation to coastal substations. It's projected at 18 million over 2023 and 2024. And I'm going to turn the panel's attention to OCC 495, that company's response there. I just want to take a minute to refresh yourself with that, because I will also be referring to the interrogatory response to RSR 101 in conjunction with this.
Sorry, the first one was OCC 495, correct?
That's correct, and it's on the screen, and we can toggle between these, I believe, as needed.
I wish I could see it. OCC 495. Okay.
So 495 discusses the coastal substation flood mitigation projects. RSR 101 is about the Clean Earth program, if that's a fair way to characterize it. So could the company explain the need to invest in additional flood forecasting tools when the company has completed flood studies and has already significantly advanced mitigation projects? And the addition of these insights can only be assessed and, quote, may have a material impact on the company's flood prediction accuracy, end quote, which implies that it also may not. Could you just speak to the need for that additional work?
Well, mitigating the coastal substation flooding will mitigate a huge exposure for the company. Loss of those substations would be catastrophic if the flood waters exceeded the level of our facilities there. But we have infrastructure in those areas that will not be mitigated, right? So those areas of Bridgeport and so an understanding of where the flooding will go is still of value to operations. And the ability to predict and project it.
Thank you. So why does the company? So why are flood forecasting tools required prior to the identification of the flood risks that would be part of the Connecticut Climate Vulnerability Study?
Are you referring to a specific passage there? Is it?
Yeah, I'm referring back to OCC 495. Would the company anticipate its flood forecasting to be fully aligned with the results in that study?
Okay, I'm sorry, repeat the question one more time, Mr. Mankowski.
So why would the company require flood forecasting tools prior to the Connecticut climate vulnerability study and the flood risk areas that would be identified in that study, if presumably they're to align?
And I guess so we use tools. Actually, I got a text with the weather that's coming, evaluating whether we will have flooding issues within our area. So we have a need to understand operationally where flooding may occur, both from inundation and coastal surge. So that is something that we're continuously evaluating as part of our storm process. We have current tools today, but we also look to evolve those. And you're referring to why we need those in addition to a climate vulnerability study?
No, not in addition, but in advance of that study. Like, would the company expect there to be climate flood vulnerability based on its own forecasting that would differ from that study, I guess is a better way to, or would it be a case by case?
I see climate vulnerability as long-term trend changes in the flooding that may occur. We have, again, as Sandy approached, our substation floors are at 10 feet, NAVD 88, which is a datum. The yard, is probably at 3 or 4 feet, and the predicted storm surge was supposed to be 14 feet if the storm had come at high tide and come all the way up into Connecticut and not turned west into New Jersey. So outside of climate change, there is significant volatility in what can occur just due to historical weather in Connecticut. And those are the tools that we invest in to try to understand what is coming in real time.
Thank you. No, perfect. My understanding is much better now. So I'm going to turn next to OCC 486, attachment 1. And this concerns, there's details there regarding the work at the new Congress for that substation getaway work. So how does UI in general determine how to include a project as a resiliency project? What goes into making that determination?
We would consider the definition of resiliency, which is that it would allow you to reduce the impact of extreme weather, or provide you the ability to respond much more nimbly and effectively.
It's fair to say that a project that has resiliency benefits could have benefits to other aspects of the company's operation.
So yeah, there are resiliency benefits. If we had a very resilient network, it would limit the impact of significant weather and reduce the resources we would have to apply in restoration. So yes, there's a definite relationship there.
I'm just going to turn around so I can actually see this document. So it's line 31 on the Excel file, the Milvin project, the Milvan pole loading?
Milvan right away, yes.
Okay. My emphasis was wrong on Milvan. It's Milvan.
Sorry.
Okay.
Yeah. It's a Milford thing.
So is this project similar to the new Congress project, or what's the difference between them?
The location is different, so and they are slightly different. The Milvan right away, for that substation, we have two feeders that exit the substation out the back. So that substation is along Route 1 in Milford. It backs up to the railroad right away, the Metro North Railroad right away. It goes underground under that railroad, and then rises in the woods and runs along that right away out into the road. And that would be a significant challenge for us if we had an extreme weather event. There are trees lining that right away. If those came down in an event like Henri could have been, that would be an extended restoration time to get back there, to get the railroad clearances, to get our vehicles in there to restore that. So we propose really a selective undergrounding project to underground those feeders, and put them in a position where they would not, in a major weather event, have a significant impact on customers and produce a significant amount of difficult work for us to do in that restoration event.
Okay, thank you. Similar to my question previously on a separate topic, did UI perform benefit cost analysis for these projects, or is it similar to the process you described before earlier?
We have not yet conducted that analysis for these projects.
So related to the Milvan project, in your direct testimony, Mr. Reeves, on page 28, you had stated that this project would help remediate pole loading issues. Is that correct?
Correct.
And also in the company's response to OCC 492, the company had represented that there's work needed to address pole loading issues. In relation to the NESC pole loading guidelines. Is the company required to upgrade all the poles on its system to meet the latest NESC pole loading requirements?
There are some grandfathering clauses there, but if we are doing work, we would be, yes.
Okay, so by the grandfathering, would it refer back to the year the pole was put into place?
Yes.
Okay, thank you. Is it fair to say that both electric and communication attachments contribute to pole loading?
In certain, yeah, when they're combined on a pole line, yes.
So for the Milvan pole loading issue specifically, is that attributable to electric, communication, or both?
On that pole line, it would be electric.
So if those poles have loading issues related.
Sorry. Yes.
Did you have something to say, Mr. Reeves? Or
I'm sorry, no, I was
okay.
reading.
So in terms of the Milvan loading issues, if those poles are overburdened by electric attachments, were those poles improperly designed in your opinion, or what contributes to that?
And I'm sorry, yeah, so in my response here, there are several areas that are, so the pole loading discussion is around some corners that exist in the route of the cables. So for those, I mean, it's not clear here to me that, so the way this is that this is written, it is out on the distribution system. So there are likely communication conductors on these poles with the pole loading. So it's a compound issue, but for this project, it's the location of the exit of the cables, and then there are some pole loading issues along the route to where they rise to serve customers. I guess when I say that they're exiting as aerial cables, so they're not aerial cables, or it's a conductor you can walk up and touch. It's not the wires that are running on the top of the pole. So we run the feeders down in the mid range of the pole above the communication conductors, and so those are running out along the railroad right away and then out onto the pole lines to the places where they will rise. So there are pole loading issues along the way as well.
Just give me one moment to review. Thank you. So in OCC 628, the company characterizes this project as a resiliency project as well.
Yes. And the resilience element is what I described with the cables running out along the railroad right away, and the impact it would be to restore that in a weather event.
Okay. If you'll indulge me for a moment. Thank you. Does the company have a consistent analysis? Or not, that's not the right word, strike that. Does the company use consistent assumptions regarding storm frequency and intensity when it's determining whether a particular project is a resiliency project?
I wouldn't say that we're using a consistent standard for that. I think we're looking at the exposure of the construction to severe weather.
So
loss. If it did come to pass that we lost that asset, what is the impact, and what would the impact to customers be? And there could be a variety of causes. It could be extreme weather. It could be a tractor trailer hitting a single point of failure. It could be a train derailing in that area.
All right, thank you, Mr. Eaves. Has the company analyzed the impact of flooding events on underground facilities? Is that part of the resiliency analysis?
Well, the one significant area of risk was the coastal substations. And the change in the FEMA flood levels that occurred after Sandy, when the coastal surge inundation was taken into account, they moved by feet, drove those. In general, the areas that flood are overhead distribution, but there are some underground facilities associated with them. Some of the underground is capable of being submerged. Our manholes, are routinely filled with water that we have to pump. Some is not. In general, we have not seen flooding to date that has caused us to have any significant programs for that in UI territory for distribution equipment. But So we haven't initiated a program for that to date. But it is something that we're evaluating and aware of, right? During Sandy, if you looked at a map of Singer substation, that's pretty inland in Bridgeport. It flooded. So the flood waters came into a significant area of the city. Most of that area was overhead. But as climate change occurs, that, those levels could get higher.
Thank you. I'm going to turn next to RSR 11, attachment 2, page 22.
Attachment 2, page 22.
Yes, and it should be up on the screen in a moment as well, if anyone needs that reference. And we're looking at the paragraph that begins with given.
Page 22, paragraph that begins with given.
Yeah, if you could just
And
take a
prediction
moment
of the
to
future
refresh your
available.
recollection with that paragraph.
Okay.
Mr. Minkowski, feel free to enlarge that type anytime you want.
Oh, my charming assistant hopefully can do that because I cannot use a computer to save my life. So there we go.
Yes, I got it. And
Can everyone see that
recollect
now?
the passage.
All right, great. I can actually see it, which is truly remarkable. All right, so that paragraph being with given, my question relates to there, and this overall document's a benefit cost analysis that Resource Innovations performed. Is that correct?
Yes, it is.
So are the circuits here that are fed by the proposed undergrounding portion, are those overhead or underground? Do you know?
So the circuits in these 9 circuits that we propose to have undergrounding, are they underground now? We would underground them as a solution for resiliency, I think was the proposal. Am I interpreting your question?
I don't know if I'm interpreting my own question correctly. Give me a moment. Thank you. Well, the circuits served by would they be underground or are they currently overhead?
So we selected 9 circuits based on a variety of factors, including reliability and other factors. And some of the solutions we looked at included selective undergrounding of portions of those circuits where it would be beneficial. Portions or all of the circuit, and we use this to contrast the costs and the benefits of those different types of solutions. Under 2 storm scenarios, one is kind of projecting the past into the future, and then one is making it worse because climate change may make it worse.
Assuming there were to be a category 1 or 2 hurricane, and hopefully that remains an assumption, for any overhead portions, are the pole lines designed and constructed in a way that would withstand that absent, a tree falling or something like that?
Given their placement in, with other structures around them and hills and things of that nature in Connecticut, I believe they would withstand the winds that they would see in a category 1 or 2 hurricane, but the urban forest would exact a significant toll.
Okay. Thank you. We're gonna move to the company's response to OCC 628. And this regards the SIMS metal management project projected at 1.5 million over 23-24. This is a customer project. So the purpose of this project is there's a load increase, but it also will avoid pole loading issues. Is that accurate?
Yes.
And the company's characterized this as being similar to the Milvon project that we had discussed.
It has an element in it that is in its essence a customer project, though. It's a significant load increase in North Haven to to add a large scale metal recycling facility.
Okay.
That to deliver it requires some underground conversion, which adds a resilience benefit. But I'd say its predominant use is customer with the resiliency angle to get it implemented.
So when there's a project like this where the company would be serving new or incremental load, and the company determines that undergrounding is necessary, is that made on a case-by-case basis, or there are a specific set of standards that the company would run by?
It's construction standards and the corners that we have to turn to get out of the city of New Haven out to that facility, and the loading issues that are created. So that's what drove the need to do something different, which created a resiliency element to that program, because it would require some undergrounding to get the size cables we need out to that facility.
Okay, so is it fair to say this is an instance where undergrounding that was required and it could not have been served overhead?
But it gets us digging in the street, which creates the potential to leverage that infrastructure for resiliency purposes. So it creates the driver to do it.
Okay, thank you. Does the customer in this project have any cost responsibility?
They would.
What would that entail? Do you know?
Well, the facilities on their property, typically we will bring for a load of that size, we will bring the conductors to their facility, and then from their facility they would have responsibilities for the construction internally. Underground conduit, foundations. We would typically provide the transformation and the primary cable into the facility, and then they would have the secondary conductors and things of that nature. But that load will be a significant load, a high load factor load that will benefit all customers if it is implemented.
Thank you. Historically, has the company included customer-specific projects, even those that include undergrounding, as resiliency projects?
No, and this one was a hybrid, and if I was categorizing them again, I may categorize this as a customer project. It has a resiliency benefit.
Okay.
It is but for that customer.
All right.
Without the customer, we wouldn't be adding the resilience element.
So, I mean, you've just said you would do it differently, but what drove the company to consider this to be a resiliency project to begin with?
Because it provided an underground path.
The undergrounding. Okay. Thank you. Just give me a moment to review. Thank you. So in the record, in the attachments to RSR 11, the company has provided benefit cost analyses for certain projects in the resiliency program, but not all of them. Why is that?
The timing of the resilience docket, coincided with the application of our rate case. So we executed the analyses on 2 of the incremental programs. The remaining programs that were in flight, we have not executed to date.
So this is just a product of when the company had to file its rate application. Going forward, the company would conduct some sort of benefit cost analysis for all resiliency projects?
Correct.
Thank you. I'm going to turn to the company's response to OCC 614. Well, it's not. Well, I'll just ask this generally. I can ask this generally. Can the company use AMI data to select certain circuits for resiliency projects? Is there any benefit from that
From
data
AMI?
that would assist the company in identifying those circuits that could benefit from resiliency initiatives?
It's an interesting question. Okay. So the C-lid analysis that we executed was derived from the AMI data that we have to isolate, the customers that had outages. And I'm thinking in terms of resilience, we're getting, it's giving us granular load data. It's giving us outage indications before the customers call. But there are other systems that are aggregating that. So in terms of resilience, I don't. Nothing is jumping out at me as to how the resilience plans we put together, we looked at the circuits and the exposure on those circuits, and the solutions were, automation, or they weren't really involved with AMI. I think AMI is very valuable in understanding load, understanding customer behavior, but not necessarily resilience influences and solutions.
No, thank you, Mr. Reeves. I wasn't looking for a specific question.
On the fly.
You passed. Moving on from resiliency. I have some question related to the authority's various grid modernization initiatives, which I'm sure the panel is familiar with. I'm going to turn first to the company's response to OCC 513. In this response, the company states it's continuing to formalize a grid modernization roadmap. Is that still accurate, or is that available in some final form?
There is a grid modernization panel coming up later in the hearing, correct?
Would this be better to wait?
Yeah, this is probably like the Clean Energy Initiatives panel.
Okay.
And Mr. Manning will be on that panel too.
Perfect.
Thank you.
Thank you, Attorney Benora. I had a feeling that this was going to occur. Let me just go over this quickly and see if I can move on. All right, thank you. So I'm going to turn to your direct pre-filed testimony on page 37, Mr. Reeves. This regards distribution automation.
Okay. Page 37. I'm there.
Thank you. And you stated there are 80 circuits where 5-year average safety performance is higher than the target safety of 0.64. Is that accurate?
That is correct.
Is UI currently meeting or exceeding regulatory reliability targets for safety?
Yes, our safety this year was 0.44, so that is under the 0.64 threshold.
for this year, for year 2022?
Thank you for last year.
Okay. Subject to check, would you agree that UI's 4-year average SAFE from 2018 to 2021 was 0.54?
Yes, I would.
Thank you. So can you tell me what system-wide safety improvements are expected from the 22.6 million investment in distribution automation that's proposed through 2027? What benefit could we see from that?
And that's a great question. And actually, the reason UI hasn't implemented distribution automation to date is because we have been looking at it in those terms. Do we need to improve system reliability performance? The REO8 outcome had us look at it in terms of the business case for the customers that were impacted and the societal value of reducing those outages. And that result shows that there is financial benefit to society through increasing the electric bill to implement the automation, but deliver the outage savings that result from that. So it will produce an improvement at the system level if we bring the worst performing circuits in line with that target, and we do that for the 80 that are above it, then the performance will improve significantly. We haven't, the analysis we did though was really focused on the financial benefit to society versus the cost of implementation, and was there a positive business case or not, and it showed that in general there was.
Okay. Thank you. Just bear with me a moment. This next question is to make sure I understand something in the record. So I'm going to turn to OCC 507, attachment 2. And in this attachment, it indicates that there were 32 proposed recloser installations in 2023 and 2024. Well, that's going to have to get bigger. I don't know if we can do that on Excel. See, oh, look at this, the marvels of the modern age in which we live. So just to confirm that this indicates that there's 32 proposed recloser installations in 2023 and 2024. And then in OCC 507 attachment 3, that's UI's reliability report. And this indicates there's proposed recloser installations and expected reliability improvements for select circuits.
Attachment 3.
So those circuits and the proposed reclosers, are those the same across these two attachments? Or are those referring to the same thing?
Yes.
Okay, great. That was a lot of work for a very easy answer. I'm going to turn next, or we can state here on OCC 507 attachment 3. And in that, the company makes it, what the company doesn't, there's a statement that it is the goal of Avangrid to deliver reliable, cost-effective electrical service to our customers. When evaluating a portfolio of potential investments, the technical and system planning group considers several key metrics to prioritize and select which investments bring the greatest improvements for the least cost. Below is a summary report of a proposed investment and the expected benefit the customers could expect to achieve. Is that generally accurate?
Generally.
Thank you. So what is the difference between a recloser installed under the distribution automation category and a recloser installed on the system otherwise? Would they be the same in terms of specifications and costs? Or is there any differential?
Currently, we have reclosers operating without communications, so they're protective devices that reclose. So if there's a branch that goes on a conductor, it will reclose several times to try to have a temporary outage instead of a permanent outage. But they operate independently. The automation would include the communications and telemetry necessary and the cybersecurity elements necessary to bring it back to SCADA over a routable communication network, and then protect this, the core control system from any unintended access.
So does that require any other additional communication infrastructure? Or?
Requires a box, communication box on the pole, and then radio.
Okay.
And associated wiring. Antenna.
When UI installs reclosers under the distribution automation program, will those be operating? Will they start operating at the time of installation, or will they go into effect at a future date?
So, I think the project, you'd have things moving in parallel. So you'd have cybersecurity work going on to protect the SCADA system. You'd have OMS development to create the screens in our outage management system to visualize the state of those reclosers. You'd have the communications work going on, and then when those things met, you would apply the automated reclosers, right? So you would need kind of the elements to come together at the end for it to work as an automation program. Now, in certain circumstances, buying the recloser and installing that immediately can get you sectionalizing benefit and reduce the number of customers that are impacted on an outage without the automation. So we would, if that can be done and that provides value, we would likely do that in advance. But the full automation benefit would not be achievable until all those parallel paths met.
And is it fair to say that as of today, UI does not have the necessary communication systems in place to achieve automation?
We have not invested in distribution automation to date, given our reliability performance.
Thank you. I want to turn to RSR 11, attachment 2. We might already be there. And in this resiliency proposal, the company considers automation as a potential solution to reduce outages on feeders. Is that generally correct?
Yeah. No, actually, to reduce the impact of outage. So we're not stopping the outages. Vegetation management is stopping the outage. In this case, the outage occurs, but the impact is limited. So we can sectionalize the system. So the tree falls. We're not stopping the tree from falling, right? UPZ stops the tree from falling. The tree falls, but the system automatically restores the customers it can. So before you would have had 2,000 customers go out, now you have 400 or 500 go out. And then we have to roll a truck to fix the 500. So it does not, it minimizes the impact of the outage, but it doesn't stop it.
Thank you. Does the company consider automation to be a core business investment solution? Or is it part of, or would you, or the company consider it to be a resiliency or grid modernization initiative?
It's a solution that can provide incremental benefit. And I think UI has struggled to come before this body and ask for the dollars to implement it, given our reliability performance in the past. I think the view that the RA8 doc had provided, to look at specific solutions and their impact on societal cost is what is driving us to do it here. That when we look at that, and if we look at the outages that occurred on those circuits, we deploy these solutions that are relatively low. It's not undergrounding, right? It's not millions and millions of dollars. It's a solution that improves the performance, doesn't stop the outage. It is worth the investment when you consider the societal costs that it saved.
Thank you. I'm going to turn next to OCC 507, attachment 2. I think we've been there before. And in there, the company identifies 32 recloser installations for 2023 and 2024. And the distribution automation budget for those years is $6.325 million. Would that equate to about $200,000 per recloser? Is that fair to say?
So the budget in total includes both the reclosers and those other parallel paths that I discussed.
Thank you. Is that estimated cost in line with prior installations?
We haven't executed automation at UI, so
there's no benchmark.
I mean, we've
comparison.
implemented reclosers, but we've talked to the vendors. We understand what it costs to implement the radios. So we've estimated that, but we haven't executed it before at UI.
Okay. The same response states that recloser locations for the years following have not yet been identified. And the remaining budget is proposed at 13 million. If you can just give me a sense of how did UI derive that number of 13 million if there's an unknown quantity of recloser installations at that point?
So the circuits that you see there, they're on the left-hand column next to the circuit number, you see the existing recloser. So we've looked at the circuits. We extrapolated, the results here to the other circuits that we would identify, and then the communications and costs as well. Security costs would be borne in the beginning. We have to secure it before we use it.
Okay, thank you. In response to OCC 507 as well, the company's included a budget request to develop and deploy a private wireless broadband solution and private cellular APNs. Why did UI decide to pursue a private network? And would this be used to support distribution automation, or would it support other grid modernization or day-to-day operations or other company initiatives?
The intent, it would have an application for automation. There would also be an AMI application. We do have a vendor relationship, I believe, for the last mile, but there are certain backhaul capabilities that I believe would provide, could provide business benefit there. So that's a secondary application, but primary application would be to support our automation here.
And at this point, would the company have any estimates of the total scope of that project, timeline, future cost? Or is it just at the initial stage?
Well, the rollout to support so it would be tuned initially to support the automation program. So these circuits are kind of distributed through our territory.
Mm-hmm.
They're not, just in one place. So we would need to install the backhaul communication capability with enough granularity to reach all the places we need to reach to serve these circuits. That likely wouldn't blanket the entire territory, but would, provide a foundation. And actually, as you begin to talk, when you get to the grid modernization panel, once you've implemented that, then the RO8 analysis, shows that those costs can be borne with the societal benefit by reducing those outages, right? So by doing that, you have now created the backbone and a significant communication potential. Probably doesn't fill in every gap in UI's territory, but a lot of them. From there, the incremental cost to do other things for storage or solar control has been borne, right? So the incremental cost of those things now is less.
Okay, thank you. We're going to switch gears back to UPZ. And I'll just state at the outset, Mr. Reeves, that I too have been a grunt on a tree crew and hurled branches into wood chippers, so we're starting on the same wavelength here. In response to OCC 604, we can pull it up on the screen. Oh, it's already there. So that second paragraph there that refers to Mr. Reeves' testimony. If you could just take a minute to orient yourself there. So how has UI determined the overall impact to annual system SAIDI attributed to the UPZ program for each year since its inception?
I'm sorry, could you repeat that?
Yeah, I believe your colleague also had.
You have SAIDI? Okay. So in that analysis, we looked at the performance of the circuit before and after UPZ was implemented.
Okay, so it's just a before and after comparison of circuit performance.
Correct.
Okay. And does the company do that for every circuit once UPZ is performed? That every circuit UPZ is performed along? It's not just a sampling of various circuits?
I think we did this analysis to make this point. We have the data to do it. We see, we know when the circuit was UPZ'd and we're collecting the reliability data on an annual basis. So the data is there to be mined. I think we were leveraging it to make this point.
Does the company track blue sky outages and storm related outages separately?
We report on them separately. We track them both.
Okay. Just give me a moment because much of this was answered earlier, so I'm just going through it again. I'm going to turn to the company's response to RSR 79. Okay. And we don't have that one for the screen, so just let me know when you have it up in front of you.
Okay.
So I just want to clarify. We're discussing the second pass, and it's a quote, a one-time effort to achieve the remaining 8 feet ground to sky clearance.
Yes.
End quote. So does this mean that the same segment of a circuit is cleared in 2 steps to achieve the 8 feet of clearance? Or is that section initially cleared to 8 feet and then later there's additional work to achieve the 8-foot specification? Just how does that work in practice?
So for the 3-phase system, we went and permissioned the 3-phase and identified the trees, the trees and the vegetation. We could take the trees and the vegetation where the consent process was not completed, and we executed half of that work in the first pass. So the second pass would, and for those trees that we addressed, we created that 8-foot window, but left about half, a little less than half of the work, basically, that we have to go back through and get now.
Okay, thank you. Has the company incorporated any, for lack of a better term, advanced technologies as part of the vegetative imagery, risk modeling for, optimal trim zones, tree health, targeted removals? Just if you could just give me an overview of what sort of approaches the company has taken in that regard.
I mean, in the permissioning process, we utilized a GIS tool to identify the trees that we were allowed to take, and those that were not consented. We're using satellite imagery to try to understand, where on our system there, the growth is on top of the wires, versus so to develop a relationship between the vegetation. We've used it on the transmission side, LiDAR, to understand where vegetation exists in relation to our transmission conductors and ensure that it can't make contact and create an outage as it did in the Midwest. So I guess those are all applications that we've used and are looking at.
Thank you. To the extent that you can answer, the UPZ program that UI performs here in Connecticut, how is that compared to the other Avangrid electric affiliates? Is it comparable generally, or is it significantly different? Any sense of that?
They are generally trimming a window. We are the only ones with UPZ here.
Okay. Generally, as part of its resiliency analysis, UI takes into account UPZ and vegetation management that's occurred on the circuit. Is that correct?
Repeat the question one more time, Mr. Minkowski.
Yeah, in conducting, the resiliency analysis under the umbrella of the REO8, the 17-1203 REO8 docket.
Okay.
Does the company take into consideration the impacts of UPZ and vegetation management work on a particular circuit?
Okay. So we've looked at, I think as we projected the performance impacts, and we've looked at the historical reliability performance and mapped that forward with and without the resiliency program that we implemented. The impacts of the UPZ that we have done are there in the actuals, right? So we've gone through half of the system. Those benefits that are driving down our reliability benefits are in the actuals that we're projecting into the future. So that is how we're incorporating the presence of the UPC program in that analysis. And then we're taking the incremental benefit that adding the reclosers or, executing the selective undergrounding would provide on top of that baseline.
Thank you. All right, we're fast approaching the end of our time together. We're going to move away from UPZ and into some questions about affordability in the context of the 17-1203 REO8 decision. On that decision at page 45, the authority discussed essentially an unaffordability threshold calculation. Or is the panel generally familiar with that? I say the panel, but now that it occurs to me, I don't think I've talked to anyone but you, Mr. Reeves, this entire time. But are you familiar with that?
Yes.
Thank you. So with that in mind, in the company's response to RSR 88, UI was asked to perform that calculation for both annual capital expenditures and annual capital additions. And therein, UI used the Handy Whitman index to escalate those expenditures.
Correct.
Thank you. In the company's response to RSR 88, does that only include expenditures, or does it also include additions, capital expenditures and capital additions?
To define the term addition? What do you mean by addition? This represents our historical capital actuals.
Okay.
And then as part of that, as part of the decision, that there's a passage in there to remove the customer connection element. So
Okay,
I took our expenditures in a given budget year and removed the customer connections to get the total, and then scaled it up using the Handy Whitman index.
That's it. Okay, that's exactly what I was going to talk about. Was that exact issue? So we're right on the same wavelength now on that. So in the REO8 decision, in that section we had referenced, Pura included customer programs. Is that, in your view, is that different than customer connections?
My interpretation of what they meant by customer programs was, that the cost to connect customers should not be included in this analysis.
Okay. Why did the company use the Handy Whitman index instead of the GDP deflator index in the response to RSR 88?
Because it's tuned to utility construction.
Okay.
And it serves that purpose of reflecting prior costs into current dollars.
Is it fair to say that index is generally used by other utilities in the industry?
And the reason I know about it is the state of Connecticut requires us to use it when we're looking at used life of our assets. So it's used in Connecticut as well.
So the unaffordability, actually give me a minute. I'm anticipating a potential objection from Mr. Venora, so I might want to rephrase this before I ask it. In your view, the unaffordability threshold in the REO8 decision, is that based on historic annual reliability program budgets, actual expenditures, or planned service, in your opinion?
Restate the question, I'm sorry.
So the affordability or unaffordability threshold in the REO8 decision.
Yep.
In your view, what is that based upon? Because it's focused on the reliability program budgets in the decision by the reading. Is there anything else UI takes into account in performing that analysis?
And I guess back to my comments when we started our discussion here, I think the vast majority of what we're doing in all of those programs, from capacity to infrastructure replacement, contribute to this. So my interpretation was that the removal of the customer connections, put this on, when you look at the capital dollars we have spent year over year, that was the dollar value that was intended to be used to do this calculation.
Okay. So in the context of this decision, in UI's view, is its proposed reliability program affordable?
In the context of this analysis.
Okay.
Now the REO8 analysis looks at, so this is, essentially what this is looking back, scaling up the capital budget for inflation and saying that you stay constant or less, right? Given Pura's support of our programs over the last 20 years, we are in a position where that is a viable option for us, because we have taken the proactive step that things aren't getting worse, right? I think we are in we're in a sustainable mode here at UI. I think the REO8 analysis looks at what investments are in society's best interest, right? So when you look at, there's a cost to your electric bill, and there's a cost for your lights not being on. And what is the value of making further investments to improve your experience, either financially or otherwise, by keeping the lights on more often? So I think those are the two affordability elements we need to look at. I think this is one criteria. The other criteria is the business case analysis we did for the resiliency projects and the automation.
All right, thank you, Mr. Reeves, for putting up with me for the last 2 hours. And we'll turn now to Attorney Will.
Thank you. All right. I'm gonna go all the way back to the questions Pura staff consultant was asking all the way at the beginning of this panel, which seems like a really long time ago now. Their questions were about the distinction between CapEx and plant and service. I had some questions because I heard some testimony there that I found a little confusing. I think I heard some testimony. I think I heard someone on the panel say that capital expenditures are not included in rates until the plant is placed in service. Did I hear that accurately?
That's correct. Capital expenditures refers to spending. So all dollars going out the door for electric to the electric system. As those projects are completed, they are then put into service, and that's when they are put into rate base.
Rate base, not rates, right? That's when they're put into rate base, but they're in rates. We're paying for them already, right? Like if you're asking for $400 million for a capital plan moving forward, ratepayers that's in rates as of the first day of the rate year, right? Do the rates increase when the assets are placed in service?
The rates change based on a rate application. The rate application is based on the revenue requirement, which includes plant additions.
Okay, so after this rate case, you're gonna go build stuff pursuant to what approvals you get from Pura. And when you're done building that stuff, it's gonna go into service. And at that point, what happens to the rate?
So the company is requesting rates be set in this case based on plant service that's in rate base. So the rate doesn't change over that period as contemplated. There are certain reporting requirements in the 2016 docket, for instance. If the company spent, I think it was plus or minus 10% of its capital expenditures, that it would come back and explain those deviations. And as Mr. Eves testified, I think over this rate period, the company's expenditures have been very close to what was projected in the last case. But the rate itself does not change from what's set by Pura in this case. And I'll just ask Mr. Hurwitz to clarify anything that I might have missed.
Well said.
I'm still confused though, because I'm acknowledging there's what's in rate base right now, and that consists of the plant that's currently in service, and that's part of the revenue requirement. But then you also have a capital plan, right? And you're seeking authorization for capital expenditures, right? So are those capital expenditures, those aren't accounted for in rates until after the next rate case? Is that what the testimony is?
You said we're seeking authorization of capital expenditures, right? And I think we just clarified that the revenue requirement reflects plant additions. Due to the interrelationship between capital expenditures and plant additions, it's difficult to forecast plant additions without also considering capital expenditures.
Right.
And I might put it this way, so the company is seeking the authority to find the capital expenditure forecast to be reasonable, as well as the plant and service forecast. As Mr. Hurwitz has testified, the two are very much interrelated because capital expenditures, when they're completed, become plant and service. That's what we reflect in the rate request.
Right. I get that. I mean, I get that capital expenditure is just capital, and that it doesn't contribute towards what's in rates until it's placed into service. And then the depreciation expense is how you get your return of your investment. I get all that. But what I don't get is the notion that it doesn't go, that it isn't in rates until it's placed into service. Still not understanding that. So like starting on day one of this rate year, after this case, there are going to be assets placed into service on an ongoing basis throughout the rate plan. Is the testimony that as those assets are placed into service, none of that is being accounted for in the rate that's approved by this decision? That all of that is going to be caught up in the next rate filing?
No.
Right.
So the company may be or is expending capital currently on its system. And for instance, a program or project today that's being built will go into service at some point for a project that's in our revenue requirement is projected to go into service over the 3-year rate plan. And so that's what we would reflect in the revenue requirement. If the company exceeds that amount, there's no contemplation of a true up to that higher amount. So I think that's the way I might think about it. I'm not sure if this helps you or not, but just the company is currently expending dollars on capital expenditures. Those are projected to go into service, and that's what we reflect. And in order for them to be reflected in our revenue requirement, they have to be going into service over the rate plan.
Right. I mean, I think the disconnect between these two tables, I think it's a timing question. Because from my perspective, representing the interests of the people who are paying this money, is they start paying this money right away. And from the perspective of a ratepayer, they don't care when stuff goes into service because it doesn't have an impact on their rate. So that's what I was just trying to get some clarification of the actual rate that's being collected from ratepayers. That doesn't get adjusted from the ratepayer's perspective based on when things go into service, right?
No, it does. So the proposal is for a 3-year rate plan. And so each year of that rate plan has its own revenue requirement, which reflects just that year's plant into service additions.
Yeah, I understand that too, but that's not, those rate escalations that are sought by the rate plan aren't contemporaneous. It's not like everything is going into service January 1 of 2024, right? It's not contemporaneous with the assets being placed into service. It's just a catch up to keep pace with what's being placed into service, right?
It is on average because we use a 13-month average for plant and service.
Okay, I think we're as close to saying the same things we're going to get, I think. Because I had the same confusion. I also heard testimony that these things aren't, that capital expenditures don't find their way into the revenue requirement until they're placed in service. So also confused about that, because like we just talked about, the revenue requirement, as I understand it, is a projection of what's going to be necessary to cover the expenses, the depreciation expense incurred by the company as it begins being incurred when things are placed in service. But am I misunderstanding that?
Could you repeat your understanding?
Sure. It's my understanding that the moment that a plant is placed in service, plant is placed in service, I understand that moves it into rate base That I get, but I don't get what I heard yesterday was someone testify that also, that it's not in the revenue requirement until that moment, until it's placed in service. That I didn't understand.
Again, the revenue requirement reflects plant additions.
Projected plant additions, right?
We have plant additions through the rate years.
Right. So it's not, so it is in the revenue requirement, like the plant additions that are expected to be incurred throughout the rate year are already in the revenue requirement when the revenue requirement's set, correct? Like the revenue requirement in and of itself is a projection of how much money do we need in rate year one. We're gonna require this much revenue by the end of the year. So that's our revenue requirement. We're gonna build what this much stuff is gonna go into service over the course of that year. That's part of the revenue requirement. So the revenue requirement is already anticipating that plant going into service, correct?
Correct. And the way it's done is there will be plant additions in each month of the rate year. And we don't assume that they all go into service on September 1, 2023. Rather, we assume they go into service over the course of that year according to a monthly schedule. And the rate base calculation, and as you said, the way this is reflected in revenue is both through a return on and of those investments. And that rate base reflects a 13-month average starting at the beginning of the rate year and going to the end. So if you want to think about it this way, on average, that's over the course of the year. The 13-month average is intended to, I think, address the concern you've expressed.
Thank you. So following up on I think the chairman asked a question that was around the same conversation yesterday about what happens after a plant goes into service. I'll back up a little. Essentially, would you agree that the process from as far up as I am looking at it, meaning with as little understanding of the intricacies as I have, basically what's happening is the company files its application. Its application includes a revenue requirement request. That revenue requirement request with regard to capital is built out of the expected needs of the return of and on the investment, as you just talked about. Pura approves what it approves with regard to the revenue requirement. And then then the company proceeds in the following rate year and builds stuff, right? So at some point it's done building stuff, that stuff goes into service, time passes. Is there a point at which Pura takes a look at what has been built again to determine whether it was made sense to build, whether it was cost effective, whether there would have been a better way to build it? And I'll jumping forward, is that point the next rate case if those questions are inside the test year?
No, there are 3 levels of review currently built into the company's current rate plan. And it's similar to what's contemplated in this plan. So the first level is in this case. So the company's put forward projections of both capital expenditures and plant and service, and provided support for that information for discussion at hearing and throughout the case. As I said in the last docket 2016, the authority also had filing requirements that the company make in the 3 years of the rate plan. And those were to report on its capital expenditures, so how it was doing against what Pura had reviewed in the last case. And if there were variances of plus or minus 10% from that the company would provide explanations. And the third level of review, as your question just mentioned, is in the next case, looking back over the amounts that have been put into service between cases,
Yeah.
to, that's as the company seeks to include those in rate base in the next case as well, that the interveners, OCC and others and the authority have the ability to review those at that time as well.
Okay, thank you. So step one is this case. So basically limited to what the company chooses to put in its application. Pura takes a look at what's put forward and does the best it can to decide whether this plan makes sense, right? That's step one. Step two is there's this compliance filing process where the company just files numbers and says, here's what you said we could spend and here's what we spent. Is anything in that process talking about what's actually happening on the ground? Are projects identified, budgets for those projects? Do you provide any detail of whether those projects are completed, whether they're functional, how well they're doing, any kind of analysis of their performance, or is it just the numbers?
My recollection is those were variance reports that we filed that were at the project level that explained where we were with each project and what occurred. Either we were on track or if we were 10% above or below, why, customer connection slowed down, increased, descriptions of that nature.
Okay, but what's being measured is just the money, right? Whether you're on track 10% or not, what you're discussing is just the budget, right?
Well, the completion of the project. So, I mean, within this case, we have specific projects that we've identified, automation, customer connection. So, I mean, we're describing that we have completed those elements and we're either 10% above or below those costs or where we stand.
Okay, so it's how fast you're building stuff and how much money you're spending.
Correct. And I mean, I think it generally described whether we were delivering on what, Pura had entrusted us to execute.
With regard to how much it will cost and how long it'll take.
And the delivery of what we said we would deliver, like the Mill Run right-of-way project we've discussed today. So it was project by project. Where are you in terms of completing that and why are you above or below?
Okay, so what other level of detail is provided that allows Pura to analyze whether the company is delivering on its promises beyond just the cost and the timeline? Within those compliance filings we're talking about?
I guess the basis we provided in the initial case around what the scope. So when we said where we were with the dollars and the timeline, underlying that was the information we provided on what the elements were. So the automation project we discussed today, and in the future case, if we had laid out a program of extra closers and where they were and what the benefits were in this case, and we said we were 100% done and it costs within 10%, then Pure would have an understanding that I think that they got what they paid for.
Okay, I'll leave that one for our brief. I'm going to move on to the testimony yesterday about that 398 miscellaneous equipment account with the $30 million, the discussion about the capital charge. My first question is, what other than that, the security equipment that was described in that particular account with a very large increase, what other than that security equipment would normally be included in that 398 miscellaneous equipment account?
Basically, the description in the FERC Uniform System account says anything not described elsewhere. So it's fairly general. I mean, we try to be as specific as we can. I think I talked a little bit about how the language is pretty dated in the FERC Uniform System of accounts. But we first would try to identify a non-general property account, right? Can we directly attribute this to a pole, an overhead line, a substation, something like that, right? And when we can't, then we look at the general property accounts, or if it's something that's benefiting both distribution and transmission, we look at the general property accounts. But it would be those type of investments that are not directly the assets in the grid. Spoken from an accountant, but more of that type of investment.
Okay. So, and we talked about how there were two reasons for that very large increase. One was that the company afterwards realized that a portion of that increase should have been allocated to transmission, but then it sounded like the vast majority of that increase was because of the phasing out of the corporate capital charge. Is that fair?
Yes, I would confirm that. And also, we have a late file now where we're gonna break out by those individual plant accounts, what was the investment that came over from UIL, UID's share of that.
Okay.
So I think that'll be helpful to clarify, yeah.
Yeah, well, because my next question is it a one-to-one? Is the increase incurred on the operating company in that account, for example, the same one-to-one dollar for dollar as it would have had to pass through the corporate capital charge if that were still in place?
Yes, with the one slight difference would be when UIL was calculating the capital charge, we were using a weighted return. So it's not exactly the same return as UI, but everything else the same, really, the depreciation, the property taxes, all of those things would be the same.
Okay.
So
And you mentioned that the corporate capital charge was an expense before. So in the event, like in prior years before that were phased out, that same, if the company incurred $20 million for a similar project that otherwise would have passed through the corporate capital charge, would that have shown up in the form of an expense?
right, so it would be, the return on and the return of that we've been talking about coming through as an expense, rather than having that addition on your balance sheet and then also the expense. So really, the change is to make that addition on the balance sheet at the inception of the project, and then the return on and the return of throughout time would be the same.
Yeah, so I'm confused about the return on part of that, because if it was booked as an expense in the past, it wasn't in rate base, so the operating company wasn't earning a return on it, right?
The corporate capital charge included a return component. That those calculations are filed in the couple of responses we referenced yesterday. So one, the RRU 254, that is what was in the prior rate plan and the calculations. And then Mr. Horowitz pointed me to OCC 122, which is the actual experience that we've had since 2017 to 2020. And then we had no charge in 2021 included in the test year.
Okay. So before the corporate capital charge was phased out, some portion, like the allowed WACC, weighted average cost of capital, in the rate plan was applied to that as well, even though it wasn't in rate base? Am I getting that correctly?
Right, UIL included it in the calculation of its charge to affiliates. That's why it used an average of all of the affiliates, is my understanding. Yes. So it would have a slight difference to what UI would experience now.
Okay.
But back of the envelope sort of calculation, it's very, very close.
Well, is the average of all affiliates weighted average cost of capital higher or lower than the company's current allowed cost of capital?
I'm not sure offhand, but to clarify, that is how it works on the company's book, or how it worked, past tense, on the company's books for rate making purposes. In 2016 rate case, PURA adjusted the revenue requirement to reflect the cost of capital charged or authorized for UI.
Okay. Got it. So the revenue requirement, and in that decision, was the weighted average cost of capital allowed in that decision applied to that, or did that decision authorize did that revenue requirement include the booked return that the parent company was using?
Subject to check, I believe it was one of the adjustments in the PURA order to change the revenue requirement to reflect the cost of capital authorized in that proceeding.
Okay. Thank you. What about carrying costs over the amortized recovery period? Is there a difference there now that it's being capitalized? Is it subject to carrying costs?
Sorry, now that it's being capitalized, you're talking about the assets underlying the UIL
Yeah,
corporate
sorry.
capital charge?
I mean, for example, that $20 million. Now that that's being capitalized, whereas it would have shown up as an expense before.
Yeah, we wouldn't calculate a return on and of those specific assets in the same way that we did when the corporate capital charge existed. Rather, the assets that were transferred from UIL to UI would now be reflected in its UI's balance of plant and service. I think that answers your question, but let me know if I misunderstood.
Thank you. What's do you know offhand what the overall impact's the wrong word, recognizing that the company testified that this is basically a revenue neutral change, right? Like that there isn't, but what's the scope of the in terms of dollars that have been shifted from the corporate capital charge into this new practice? Since I think you said this started in 2016, was that?
Yeah, it began to be phased out in 2018.
2018.
Right, at the end of 2018. Well, I think we'll get the exact precise amounts in the late file. But if I look at OCC 122, attachment 1, the average rate base at UIL being considered for this charge in 2017, before we started phasing any of this out, was about 150 million. And we used the Massachusetts formula to transfer those assets to the UIL affiliates, of which UID receives about 40% of that. So just using that as an approximation, about $60 million of average rate base was transferred to UI distribution.
Okay. Thank you.
Mm-hmm.
This is sorry for jumping around. Just this is, I was taking notes in order of how the cross was going earlier. Pure staff, Mr. Capozzi requested a late file, I believe it was late file 18, on the carrying charges for the UPZ program, asking the company to show that the carrying charges in a couple different formats. I was hoping to request an amendment to that in a couple of ways. I think we had talked about, he had requested short-term debt. I was wondering if the company could also calculate the short-term debt rate by using the most recent monthly short-term debt cost. I think the authority had asked for the average of the last 3 years. So I would ask that in addition to that, the most recent incurred short-term, or the most recent rate applicable in the most recent month in which the company used short-term debt. Does that make sense?
It does.
Okay. And I would also request, Mr. Capozzi had asked to show those carrying charges as the weighted average cost of capital. I was hoping that the company could add to that the requested weighted average cost of capital from the 3 different witness panels in this case. So OCC's recommended WACC of 6.69%, EOE's recommended of 6.33%. And showing my bias here, I didn't write down the company's requested WACC, but I'm sure it has one. So, because my understanding that the late files requesting my understanding from Mr. Capozzi's request was that the weighted average cost of capital he's asking you to show is the current allowed weighted average cost of capital.
Okay, Attorney Wheel, and maybe this is where you're going, but I had a similar request in late file exhibit 19 about storm expenses. So the one we were just talking about in late file exhibit 18 is for UPZ. So are you requesting the same changes to 19?
Yes, thank you. That was going to be where I was going to go next. And one last question. There's also different. Mr. Capozzi asked for long-term debt rate, I believe, also, and I would ask that also be that the company add to that OCC's recommended applicable long-term debt rate from our testimony, which is 4.38%, as well as the recommended long-term debt rate shared by EOE and the company, which is 4.32%, which I think differs from the current long-term debt rate that would have been applied.
That should be doable.
Thank you. I was going to apologize. I mean, it should be doable by us too, but it's just handy to have it all on one piece of paper. So I thank you. All right. The next question is for Mr. Eves. The staff was asked you several questions yesterday. Again, I believe it was Mr. Capozzi. He did a good job yesterday. Actually, maybe that was this morning. My timeline's getting confused. Anyway, Pura staff asked you some questions about the kinds of projects that are put in the resilience category of spend as opposed to the reliability category. Do you recall the line of questioning?
Yes.
And in response to several of those questions, I heard you talking about how some of those infrastructure replacement programs are driven also by safety. Is that right?
I believe I was talking about the infrastructure replacement programs.
Yeah, but and you were talking about. Did you just say you don't believe you're talking about the infrastructure?
No, I was talking about.
Okay, and you were testifying that in addition to general resilience and reliability, I think, not to put words in your mouth, that there are also safety reasons for safety justifications for those programs. Is that correct?
I think the way I characterized it was that it starts with that and it produces resilience and reliability benefits as an outcome.
Okay. Does the company consider safety a separate category of spend that's distinct from resilience and reliability?
Safety is I wouldn't say it's a category of spend. It's a guiding principle for our company first and foremost. But when you look at why you replace a pole, right? Why you inspect and replace a pole, you're inspecting the ground line strength to ensure that it doesn't come over. That is a safety implication. So in doing that, if we identify those poles that have that risk, if we maintain them, relative to NESE standards, so that the weather conditions they see don't cause them to fail, then it has a reliability benefit over the long term. But the reason we went out there and did the work was the safety driver initially. And when you look at a splice chamber rebuild, I mean, the implication of not doing that is a cement truck falling into a manhole. So again, I think the primary driver is that safety implication. By doing it, it produces reliability and resiliency benefits as an outcome.
Yeah, I understand that, and certainly don't want to suggest that safety shouldn't be considered at the level that it is. But I guess I'm just confused because it seems like the company categorizes these programs based on those resilience and reliability. But if safety is kind of the primary driver, I'm confused about why there isn't sort of a safety category.
Well, I've identified it in terms of function, which is infrastructure replacement, right? So it has a safety implication and it's being driven by safety drivers. So the way we've categorized them is infrastructure replacement. That's separate from the resiliency category we had in our budget.
Okay. Thank you. I have some questions. have some questions about the Bridgeport Avenue property. I'm just trying to get a sense of how long it'll take to get through them, Madam Chair, whether it makes sense to drive through to 5:30. Happy to keep going.
Are you gonna wrap by 5:30?
I don't think so. Nope.
Okay.
I could probably wrap at like 5:50.
Listen, it's my birthday. We will not be staying until 6.
Happy birthday.
So, yay. You know what, on that, we're gonna close for the day. So, let's plan to come back tomorrow at 10 a.m. We'll resume to finish the OCC's cross, and then I believe we have cross from at least the AG and EOE and the bench. So, Attorney Venora, I do think we'll get to your O&M panel tomorrow, but I would assume not until after lunch.
Thank you. That's helpful.
Okay. All right, anything before we wrap? All right, thank you, everybody. Have a good night.
Thank you.
I'm just saying.
No,
For future reference.